Today, they announced for users that want to take advantage of Copilot, that's an additional $30 a month. We ran some quick math, and essentially, if they're able to just convert 5% of that user base over to this new Copilot SKU, this could add almost 40 to 50%, 40 or 50 points of growth to their Office 365 business. Obviously, that's a big number. A lot of these users are on lower price plans, but certainly it's a huge install base, and the magnitude of this price really surprised us to the upside. Many were expecting the price to be kind of in the $10 to $15 range, and we got $30 today.
How much of a lead does Microsoft have in the AI space, Tyler? I mean, I could imagine when hearing about all of these Copilot products, some people actually switching from iOS back to Windows, if it's even called that anymore, I'm not sure, right? Because nobody really wants to use Windows outside of an office place until maybe now. Can it actually move the needle on even computer sales?
It's certainly possible. I think the biggest driver, though, is going to be around the opportunities that beyond PCs, right? I mean, I think the Microsoft years ago kind of lost the mobile battle, right? You remember Windows Phone, and we don't see too many of those around here today. So this is really around kind of the next layer of computing, their share in cloud computing, their share in productivity, and potentially search. Now, search, to your point, is an interesting market. This is a market Microsoft only has 2 or 3% market share. It's dominated by Google. They actually announced a separate enterprise search product today. So that's also an opportunity.
That's fascinating stuff, Tyler. I got to wrap it up there because of a computer break, but thank you so much for joining us. Tyler Radke from Citigroup talking about Microsoft. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
Look, I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, only on Bloomberg TV and Radio. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The great rotation begins. Dow Industrials outperforming the broader market by the most in 7 months. Live from Studio 2 at Bloomberg World Headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And we're looking at another up day in the markets, a risk-on day, if you will. You take a look at the S&P 500 up by 0.6%. You look at the NASDAQ 100, your big tech stocks, getting a boost up 0.7%. A lot of that coming from Microsoft, which we're going to get into. I did want to take a look at oil here because it's nearing in on $76 a barrel, really joining in on this risk-on market mood. You can see oil up about 2.4%. And of course, we are in the thick of bank earnings. Bank of America, just one of the banks stepping up to the stage today, delivering a profit beat. Romaine, shares up about 4%.
Yeah, a big day for the big banks here. They did beat expectations, particularly Bank of America, on that net interest income expectations. Citi, of course, beat expectations on net interest income as well. Bank of New York Mellon out this morning, also getting a boost from rising interest rate. Even Charles Schwab, right now that stock having its best day in almost 2.5 years as the bank deposit exodus appears to be subsiding. And of course, Morgan Stanley increasing its debt underwriting revenue. A bit of an upside surprise there. We're going to have more from that sit-down interview with Morgan Stanley CEO James Gorman in just a bit. Now, the stronger than expected bank earnings giving a lift to the markets here, but so too is the latest read on U.S. retail sales. That so-called control group of sales, which excludes the volatile items like food service, auto dealers, and gas stations, up 0.6%. That's twice the prior month's pace. Another data point of consumer resiliency out there that is aiding a rotation, yes, a rotation, into more economically cyclical stocks, Katie Greifeld. And that really brings us back around to the hopes and dreams of investors of that proverbial soft landing.
And we saw that in Bank of America's Fund Manager Survey for July 2023. The results here are really interesting. Just 4% see a no landing in the next 12 months. I still don't know what that means, so it's probably for the best that no one really sees it's happening. Hard landing coming in at just 21%, and 68% of the fund managers surveyed expect a soft landing. Of course, that has been the goal of Jerome Powell. It seems like that is Janet Yellen's base case, but then you look at the yield curve and it tells a different story. If you take a look at the recession probabilities that are derived from the global yield curves, from the 2s, 10s U.S. curve, and then from Powell's preferred model, which is the 3-month, 10-year yield curve, you can see that the recession probabilities in the U.S. have really ticked higher, and they've stayed there throughout 2023. So if investors are worried about a recession, Romaine, you can see it in the bond market, but not necessarily in the stock market.
All right, well, let's continue this conversation right now with Linda Dissel, Senior Vice President and Senior Equity Strategist over at Federated Hermes, helping us kick off to the close here. Hey, Linda, I don't know what era you're from here, but a lot of us sort of remember the old Terry Bradshaw to unintentionally going to Franco Harris there, the immaculate reception, and now everybody's talking about the immaculate disinflation and whether Jay Powell might actually pull off this so-called soft landing.
Well, I appreciate the shout out to the Pittsburgh Steelers, which is where I hail from. And of course, I was around at that time. And I don't know if we'll have an immaculate disinflation. Only time will tell for sure. But we have said at Federated Investors all year long that you would see a dramatic decline in inflation. And of course, you are. The question is, where does it stop? And is that enough for Jerome Powell, who insists he wants 2% inflation? It seems like we can get to a 3% inflation core by the end of this year, or 3 and a little bit more, and that would actually be fine unless Jerome really means it and he wants to go to 2 and he keeps on tightening. For, history says the Fed has an excellent history of putting you into a recession with their tightening.
It'll be interesting to see how they thread that needle. We should point out the market seems to have finally come around to the idea of another rate hike next week. That's now being fully priced into the market based on Bloomberg pricing on the terminal here. And of course, a lot of people, Linda, expect another one potentially in September here. But once you get there, you have a lot of folks not only just talking about a pause, but maybe even a potential cut. Even Richard Clarida, former vice chair, kind of said just as much yesterday.
Well, don't you find it interesting, Romaine? There's been quite some time now that consensus has said they're just going to do one more, and then we get used to it, and then, well, they're just going to do one more. We think they're just going to do this one more. That's what we think as well. But, he has to see how inflation does, and we remember that he came from 0% Fed funds. So all these hikes are only really taking us into restrictive territory since the beginning of this year. So we need to really wait and see. And then as far as a cut is concerned, our view has been all along that we will stay higher for longer. And you know what? You would rather have that, because history says that when the Fed cuts interest rates, once that happens, historically, it's you start to go down into the market. You fall for about another 200 days, and you fall for about 23%. That is the market saying, oh my gosh, they see a recession. Higher for longer would not be the worst thing.
Well, that's what I want to get into, because to your point that you get a rate cut, and usually when you get a rate cut, it's not usually good news. You see some falls from there. But when we think about higher for longer, and we think about a Fed funds rate north of 5%, what areas of the market would feel pressure from that, even if the overall index can sustain these gains?
Well, of course, we've been used to very, very low rates, generational low rates here for about 15 years. So it seems like a 5% rate is a high number. I was there in the 70s when we were double-digit interest rates. This is nothing close to that. So you look at the long-term interest rates, and the higher they are, the worse that is for the long-duration assets. The growth assets, which of course have been ruling the market this year, that is what would get hurt, or rising interest rates hurting small company stocks, because they're the ones that have to borrow more. They don't generate as much cash as the large companies do. Well, guess what? Small company stocks, 50-day moving average just crossed over the 200-day, and that is a very bullish sign for a momentum. This is a market that feels maybe there is going to be a soft landing.
Well, Linda, I'm looking through your notes, and I loved this line. It's getting harder to be a bear. And it's interesting to read that, because there's been a lot of ink spilled over concentration in this market. It's getting harder to be a bear. Is that a call that you see a broadening out of this rally, or is gains from 7 stocks enough to keep things going?
7 stocks is definitely not enough, and you are seeing a broadening that is occurring. The broadening that I've suggested just now, as well as for small caps in general, we're seeing a broadening, just a resiliency across more areas of the marketplace, more cyclical areas. I think you mentioned in your introduction the energy patch, which has been underwater pretty much this year, is starting to get a look-see again. So people looking around and saying, where can I invest in AI beyond the big 7, the magnificent 7? How else can I invest in maybe even in and around the world, if around the world we see nothing more than a mild recession, which has been our base case for the back half of this year?
All right, Linda, going to have to leave it there. Always great to talk to you. Linda Dissel there, the pride of Pittsburgh, senior equity strategist over at Federated Hermes, helping us to kick you off to the closing bell. Coming up here, we're going to hear more from that interview with Morgan Stanley CEO James Gorman, as the bank's shares right now up about 6% on the day, Katie.
Plus, 2 former Citadel traders have raised $1.85 billion to launch the biggest hedge fund startup of the year.
And we got a 6% gain on Morgan Stanley. How about a 5% gain for Microsoft? Right now, trading near a record high on the back of pricing power when it comes to AI and the products that it's going to offer. Still a week away from those earnings, but investors making a big bet on that company's future. All that and more coming up after the break. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Well, just in the last hour, Bloomberg's Sonali Basak spoke with Morgan Stanley Chairman and CEO James Gorman. They discussed a variety of topics, including the bank's second quarter earnings results. Let's take a listen.
The fundamentals are really strong. Our capital ratios, I mean, we'll see when all the banks report. We're close to the end of the major banks. But I'm pretty sure we've got the highest capital levels of any bank, any major bank in the U.S. The net new money numbers you referenced are obviously evidence of growth, and our dividend is 4% or close to it. So a combination of really high conservative capital levels, obvious organic growth within a couple of core businesses, and very high dividend yield for what we do. I think the investors sensibly look past what's been going on in the market recently. You know, IPO activity is obviously down, M&A activity is down. Some of the fixed income trading was a little more muted. None of that matters, right? Strategically, that doesn't matter. That's a point in time market sentiment. That will change. Deals will get done. Companies will go public. People will trade. So I think the market sensibly looked at the big picture items and said, yeah, the rest of the stuff will just come. And that's why we're trading the way we're trading. It was a great, clean quarter.
When you look at investment banking, trading, advisory, when do they come back and how robust will that activity be?
Well, I don't know when exactly. I do believe it's bottomed. And we were just talking before we got on air, you know, I've been to, in the last couple of months, Australia, Japan, Saudi, France, England, Amsterdam, I mean, and all over the US. And every CEO I'm talking to has tilted to a more forward-looking posture. So I think deals will start getting done. Whether they happen in the back half of this year, I'm not so sure. It might be next year that it comes, but it will be during next year when we see it, if not this year.
James, what does all of this mean for headcount? You've booked a more than $300 million cost tied to severance packages, but it seems like headcount is starting to stabilize. Do you think that a rebound in some of this activity means that you could bring more people on, or do you still see more cuts in certain areas?
Not really. I mean, we laid off about 1,800 people last December, and we knew that was an optimistic view. And I said to the team, if by April things haven't turned, we'll have to unfortunately do it again. And we ended up laying off another 3,500 people. Now, against that backdrop, we've had attrition, I think, is running almost 50% what historical rates are. We've got 83,000 employees. We bought 2 huge companies, E-Trade and Eaton Vance, and we guaranteed everybody their job during COVID. So headcount was, if you will, artificially high. I regarded this as bringing us back to what the normal run rate should be. I don't think we're going to add to that. I mean, one of the beauties of this business, it's very scale driven. If you do a few more trades, you don't need more people to do it for the same clients. So, no, I think we're about right with headcount right now. But obviously, you know, we've got fiduciary responsibility, shareholders deliver returns, and we watch that carefully.
That was Morgan Stanley CEO James Gorman speaking earlier with our own Bloomberg's Sonali Basak. Thrilled to say that Sonali joins us now. And Sonali, he sounded pretty certain, saying that we've bottomed when it comes to investment banking, but less certain when it comes to the deals outlook.
Yeah, it's interesting because he doesn't know when it'll come back or how heavily it will come back, but it sounds like there is some pent-up demand underneath the surface here. I think equally important here is what it means for jobs, because this idea that Morgan Stanley is only running at about 50% of its normal attrition means that even if there are not going to be many more job cuts on Wall Street, it's not going to be that easy to run around and find a job still on Wall Street, because they are not the only ones here where headcount has expanded from prior years and only come down kind of marginally in the last couple of quarters, couple of months. So interestingly here, he is pretty sanguine. He doesn't necessarily believe that there needs to be a recession. There's nothing that keeps him up at night. And the lack of those worries you really see reflected in the stock. And this general optimism that things will come back, though it's unclear about what that looks like.
All right, I think what everyone wanted to know about Sonali was the question about succession. And he seemed to dance around that a little bit. He mentioned, of course, they have 3 candidates that I think Bloomberg has reported out on, internal candidates here. Do we get any sense, though, as to how close we are to a decision being made?
One thing I tried to do with him, Romaine, is kind of wheedle down whether that CEO would come from one of the growth businesses, wealth management, investment management, and that is something he absolutely would not bite on. He had given the criteria of what it takes to be the next CEO of Morgan Stanley, and he said really it comes down to the ability to run a business moving forward, especially because there are going to be new challenges for that person ahead, given that there's new regulatory challenges. In the near term, you could watch James Gorman fight some of those. He said that he would certainly sit up and say that there shouldn't be rules this stringent on the American capital markets, especially for more stable fee-based businesses. But remember that wealth and asset manager, that is the place where Morgan Stanley is raking in a lot of money and generating stable fees and could come under pressure in the future.
All right, Sonali, great interview. Sonali Basak down in Midtown Manhattan at Morgan Stanley's headquarters, a sit-down conversation with the CEO of that company, James Gorman. Let's get some reaction out of our next guest, Chris Katowski, Managing Director and Senior Analyst covering large-cap banks over at Oppenheimer and Company. And Chris, I do want to start off with the results that we got out of Morgan Stanley. I think the bump up that we saw in some of that fee revenue, particularly when it comes to some of the debt underwriting, kind of surprised to the upside here for some folks.
Yeah, I don't think you can read that much into it because it's still you're still kind of in the middle of winter, right? I mean, it's like it's in February and you have a warm day and it's 27 degrees, and it moves to 28 degrees the next day. You can't extrapolate from that. But I do kind of agree with James that, the outlook, it's almost inevitable that it comes back by sometime next year, barring some kind of external shock.
Barring some type of external shock. And I mean, that's not really a bold statement. I guess, do you think some of the optimism is warranted right now, not just from Morgan Stanley, but what we heard out of Bank of America and then last week with Citigroup, this idea here that at least the worst case scenarios, at least right now, seem to be behind these banks?
Well, let's put the banks, let's put investment banking aside. That's going to be episodic. It's going to be deal driven, and I'm optimistic there because the private equity companies, which I also cover, have a ton of dry powder. There's been a lull in deal activity. It only takes a while, and with a broader equity markets going up, and longer term rates being relatively stable the last couple of quarters, it's an environment that's going to, I think, likely generate deal activity. If you think about the more normal commercial banks, they're the ones that have really taken it on the chin so far this year, and it's primarily been fear about interest rate movements in the wake of the Silicon Valley collapse. And, I think that's really misplaced. The BKX is down about 15% against a market that's up 18% so far this year. And there is kind of a fear that, the same kind of collapse that happened at Silicon Valley and those other two small banks could infect other banks. And I think it's becoming clear that that's not the case, that those companies were outliers. They had a much narrower kind of business model than most of the banks that you cover and see on the street corners. And so I think what you see in the stocks today, I think, is people beginning to make that distinction.
And Chris, let's talk a little bit more about Bank of America specifically, because right now it looks like shares are up about 4%. Of course, they did deliver a second quarter profit beat. And we heard from CEO Brian Moynihan saying that all businesses performed well. When you look at these results, though, is there anything that gives you pause?
Oh, I think it was a pretty unambiguously good and consistent and stable quarter. And, the thing is, again, these stocks have traded off a lot this year, and they've traded off primarily on the fear that, if you look at their bond portfolios, there's a mark-to-market loss in anybody who bought any bonds over the last couple of years. And I think the point that Bank of America, I think, made very convincingly on this call is that, really, as a result of the COVID stimulus, they had this real excess of liquidity that they had to invest some of that in bonds. Mm-hmm. And so there's a mark on those. But if you look at overall, the company also has, on the other side of the balance sheet, has a lot of, long-term liabilities that would have benefited from the rise in rates. And you see that in general. So, if you stand back, big picture for the commercial banks, between the second quarter of last year and the fourth quarter, net interest income went up 22 or 23%. Mm-hmm. And then following Silicon Valley, there was the fear, oh my God, we're going to give all that back. And, what's happening is, no, we're only giving back a little bit. Net, higher rates are still a benefit for the banks.
All right, Chris, good place to end it. Really appreciate your time. That is Chris Katowski. He is Managing Director and Senior Analyst over at Oppenheimer. Coming up, the biggest hedge fund startup of the year, bringing in nearly $2 billion. We have the details next. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
All
right, two former Citadel traders out there raising almost $2 billion in what's going to be the biggest hedge fund launch of the year. Bloomberg hedge fund reporter Catherine Burton joining us right now with more on this story. Former Citadel traders, that's a pretty good pedigree. I guess there's a reason why they were able to raise that much money.
Yes, it's true. It's all about the pedigree these days.
Yeah, and you're not really seeing a whole lot of, at least major hedge fund launches here. I mean, besides their background with Citadel, what else did they have to offer investors?
Well, they're kind of traditional long-short equity managers, which is a little bit odd that they've managed to raise so much money because it's not a strategy that people really love right now. But they've managed to do that, and I think it's mostly the pedigree. We have a launch that's coming out in a few months that's also another Citadel trader, so that definitely helps in raising big money.
Citadel helps have that on the resume. And talk a little bit more
I'm
about...
going to put it on mine tomorrow.
I know.
It may not be true.
Put it on LinkedIn. It's fine. But talk about how this year overall has been for raising money. It's been difficult on the deal-making side, on the IPO side. But when it comes to raising money for hedge funds, how's that going?
Well, there have only been 4 funds that are planning on opening this year with more than $1 billion. But the amount of money collectively that they're raising is actually more than it was last year. So we're seeing it was very much before the financial crisis. They raised collectively like $20 billion. It's kind of fallen from there, and now it's circling back up again. So that's a positive. Next year, we think there's going to be a fund run by Bobby Jane, who came out of Millennium, that could be the biggest hedge fund launch ever at more than $8 billion. I mean, we'll see how it pans out, but that looks to be that could be the biggest ever.
When you talk about the potential investors there, I mean, what do they sort of look for here? Is it just about the managers themselves? Is it the strategy? You mentioned long, short, not necessarily in vogue right now. Or are there other factors that they look to when they decide whether they want to pony up some money here?
It's both pedigree and strategy. Now, maybe people think that it's going to be a better environment for long short now that we're seeing a little more volatility. There's more chance to make money on the short side, which hasn't been the case for a decade. So it's a little bit both.
All right, and they say they were going to plan to cut this off when August, the beginning of August?
Correct.
Okay, all right, so maybe a few more bucks might roll in between now and then. Catherine Burton, Bloomberg hedge fund reporter. A look here at, well, the latest and the biggest hedge fund launch of the year. Jonas Dietrich and Dave Sutton starting off on their own, raising $1.85 billion. Meanwhile, let's get a quick check of the markets here. Session highs right now for most of the major indices. The NASDAQ Composite, the NASDAQ 100, which had been the relative laggards earlier in the session, now trying to punch their weight up about 1% on the day. Outperformance on this day, Katie Greifeld, Dow Transports up 1.7%. Your favorite?
Once again, you can just rely on those transports. Let's talk about the bond market really quickly. Pretty much unchanged on that 2-year yield. We had been below 470, no longer, just back to unchanged.
All right, take a look there at some of the individual movers. Morgan Stanley having a great day, up 6%. Stick with us. This is Bloomberg.
does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
This is Bloomberg Markets to close. Almost 2:30 here in New York. Let's get you caught up real quick on what's going on in the commodities space. Watching settlement right now of NYMEX crude futures. A bit of a reversal from what we've seen in the previous days. WTI up about 2% here on the day. Settlement is going to come in above that $75 a barrel level here. This is part, of course, of that broader move in risk sentiment, at least that we're seeing here in the United States. The story overseas is much different. Still some concerns here about the second largest economy, China, and whether they will continue to be the big buyers of some of those commodities, including base metals. Aluminum on the back foot for yet another day, down to more than 2%. Copper futures over in London also settling lower, below that $8,500 level, down about 0.2% on the day. And keep an eye on what's been going on in the yield space, because that's having a direct impact on gold futures. Gold now making a run towards 2,000, up 1.2% on the day, 1,981 and change.
Well, we go from commodities to shares of Microsoft, absolutely soaring today, up over 5% after the software giant revealed pricing details for its corporate artificial intelligence products. Bloomberg Intelligence analyst Anurag Rana joins us now. Tell us a little bit about Microsoft 365 Copilot and whether $30 a month seems like a reasonable price.
I mean, it is a hefty price, but, you know, at the end of the day, this is a company that's coming up with products way before than anybody else is trying to figure out their strategy. So I think this just shows that Microsoft is well ahead in this game compared to the other software vendors. And it's not just the Office suite. I mean, this really has direct impact on their cloud business because, you know, all these products run on their cloud platform. So I think overall, this is very good news for the company. Just on the dollar size, I think it is a bit steep, but over time, we think the price could go down once the computing costs go down that are associated with running generative AI workloads.
And just to be clear, Anurag, is this mainly geared towards corporations and their employees, or just can regular individuals also subscribe to this as well?
Well, you can subscribe it from a consumer's point of view, but, you know, frankly, the biggest push is for the enterprises. You know, another product that came out was Bing for chat. Now, imagine this. Companies are really scared of running ChatGPT in their internal data. They're very worried about, you know, what the system can learn from their internal data. Microsoft is launching the product, another product on this, where enterprises' data will be secured within the firewalls of the company. So it can push the companies to use some of the Bing products that they have not used so far.
And Anurag, I'm reading your research that you put out right after we got this news. You wrote that you expect the cost to go down over time as the product gains scale. Is that scale going to come from already Microsoft clients, or do you see this actually expanding out and bringing in new clients to the Microsoft Office suite?
No, when we say scale, it's really the cloud infrastructure cost, because as I said, the cost to run these workloads are very high. Right now, they perform, a very tough task, and it, the cost is several times more. Over time, when the cost to run these workloads go down, Microsoft may decide to, reduce the prices for the add-on, module of this thing that could embrace, a lot more adoption of this package.
I am curious about some of the growth projections that they've put out there. The CFO a little bit earlier had talked about how this could be the fastest business to hit 10 billion. And then I was going through some of their other business, their legacy businesses, and looking at how long it took for them to really get to that behemoth that they were. And it was a pretty long road. Well, why is there so much more bullishness on the speed of which they can get up to 10 billion?
See, one of the things you have to remember, as I said, in our view, the number one place where you're going to see massive adoption is the cloud. Because so far, Microsoft's real footprint is in on-premise databases, on-premise workloads, and those are the ones that need to be shifted onto the cloud, because that's where, in order to run some of these Gen AI workloads, you really need to be on cloud. So that's really, I think, the biggest beneficiary, and that's an area where they can close the gap to Amazon, where they're the number 2 player out there.
Anurag, really appreciate the instant analysis. That is Anurag Rana of Bloomberg Intelligence. Microsoft shares currently up 5.5%.
Have you subscribed to this yet?
I haven't.
Okay.
I still have to download Word on my computer. But in any case, still ahead. We're going to get more insight on bank earnings from Ken Leon. He is research director at CFRA Research. That's next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
New York City.
In London, in Sydney,
from Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Pinterest. Evercore upgrading to outperform and raising the price target to a street high $41 a share. The analysts feeling bullish on digital ad spending and feeling good about operational improvements made by CEO Bill Reddy only about a year into the job. Shares up by 4% on the day. Next up, let's take a look at Carnival. Argus Research upgrading to buy because of increased marketing spend, strong free cash flow, and recent record bookings. The analysts also saying that Carnival's efforts to update its fleets already starting to pay off. Shares up about 3% on the day. And finally, let's take a look at Citigroup, upgraded to buy from hold. This over at Odeon Capital after its earnings report last week. Analyst Dick Beauvais noting that Citi benefited from higher interest rates and has a more positive longer-term outlook than its peers. Is also looking forward to an improvement in the capital markets business overall that will weigh positively on Citi's earnings in future quarters. Those shares up almost 2% on the day, and those are some of our top calls. We do want to stay in the banking space, in the sell side space, and talk a little bit more about some of the earnings that we've gotten and, well, some of the bank earnings still that need to be reported. Ken Leon joining us right now, Research Director over at CFRA Research. CFRA has lowered its ratings on both Morgan Stanley and Bank of America recently. And let's start, Ken, with those two banks there. And let's start actually with Bank of America. I was actually somewhat surprised, pleasantly surprised, with the results that we got out of them. Was there something in there that maybe gave you some concern?
So, I mean, directionally, we're just not going to see a V-shaped recovery in the second half. Actually, slower economic activity. So that doesn't bode well either for traditional banking or the really needed rebound in investment banking. It's just going to take longer. Additionally, we're seeing loan growth slow down. There's no risk really that we see on the deposit side. But when you look at all the businesses across Bank of America, stable with investment and wealth management, there's nothing really to get too excited about. And compared to JP Morgan Chase that reported last Friday, which is the closest peer, they're one or two steps behind.
Well, and then we'll talk a little bit more, I guess, about the competition that we're seeing now. We just had an interview with James Gorman over at Morgan Stanley. He kind of alluded to this, although he put it more in the context of sort of non-banking or at least non-traditional finance companies taking some of the business away from banks here. How much of that is a concern of yours?
It's significant. There was a story in the Wall Street Journal months ago. 50% of the banking system is not regulated. It's called shadow banks. And when you get to smart money looking for attractive returns on credit, it's really going to the large private equity firms, the Apollos, the Blackstones, et cetera. And yet, you know, what the banks face, and this is kind of the pet peeve for James Gorman, is probably higher regulated capital over the next few years. And that's really the dilemma that the banking industry has, particularly the large banks, is that someone else that's not regulated is able to take handsome returns.
Let's talk a little bit more about Morgan Stanley, because you downgraded your view on the company to buy from strong buy. And it was this line that really caught my eye. You wrote that you're lowering your price target basically to reflect a hybrid valuation of part investment bank and part asset/wealth management firm. Walk me through that a little bit more. If Morgan Stanley was just an investment bank, if it didn't have this asset management part, would the valuation be higher or vice versa?
Yeah, it's a great question. And kind of the mechanics of that is that unlike its closest peer at the time, Goldman Sachs, Morgan Stanley's made the right strategic decisions, expanding its asset and wealth management businesses. More stable in the public equity market, that stock's going to get a higher multiple. So I say a hybrid because they still obviously have an investment banking franchise, which is still at the trough of the cycle. When you put them together, you still cannot on the table say Morgan Stanley deserves the same kind of multiple as a BlackRock or even a Schwab. So it's somewhere in between. But the market recognizes that, and they have rewarded Morgan Stanley really in the last year or two, because out over 10 plus years, they had to build those businesses and show the differentiation compared to just saying it's a cyclical investment bank, we can't forecast it, therefore you're going to get a low multiple.
And we don't have a ton of time left, but I do want to talk about Goldman Sachs, of course, reporting tomorrow. Has the bar been raised after the round of earnings that we just saw from its peers?
No, it hasn't, but a lot of these bank stocks are up today for two reasons. One, bank stocks have been really flat in the water or down. S&P 500 up 18%. And earnings estimates have come down significantly for Goldman, as they have for our views. But it's, again, no V-shape in the second half. What do they do next after big write-offs in their diversified consumer areas? So it's going to be a good show from Goldman Sachs tomorrow.
All right, Ken, great to talk to you. Ken Leon there over at CFRA. A look at some of the bank earnings behind us and some of the bank earnings up ahead. Still more to come here on the big program, including a sit down with Mickey Drexler. You know him. He's the chairman and chief investor over at Alex Mill, and of course the former CEO at Gap and J. Crew, a man who knows more about the retail space than anybody out there. That conversation after the break. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to Bloomberg Markets to Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joining us as he does every day at this time. And David, as you know, there's been a big focus on the consumer spending. And we got some retail sales numbers this morning that showed, at least on the margins, we're still going out there and buying things, including clothes.
Exactly, and particularly apparel. Apparel was up more than anything else. And so since apparel is up, we had to have the person who knows apparel like no one else. He is Mickey Drexler. He is the Alex Mill chairman and chief investor. He's a former Gap and J. Crew CEO. Mickey, great to have you with us. You do know this space better than anybody else. Well, where do you think it is? And we know globally sort of it's coming back some. What are you seeing? Because you really know what's going on in real stores.
First of all, I wouldn't say better than anyone else. Because then if you think that, it's over. So what do I think is going on? First of all, I wonder how the government gets the retail sales. They never called us in any of my companies. So I always see 3.2, whatever it was. How do they know? But that's a whole other discussion. I think this is, well, before I go on, when I'm on here, and I do it regularly, is to, I called 4 or 5 of my network/friends to ask them what's going on in their world. Because, you know, Alex Mill, that's my infomercial. Yeah. Alex Mill is a small, growing apparel company, but I want to get what the big people are doing. Business is very mixed from what I hear and what I see. And I think it's going to be tough. I'm talking more about what's around the corner than where it is today. I think the retail business has, and I always say this, too much inventory, too many choices, not focused. And the businesses, and in terms of sales, what are the margins? There are some people still left with heavy inventory from what I hear, others not. But at the end of the day, almost everything seems to be on sale. And once you put that needle in, it's really difficult to get off of that.
We've come off of a pandemic, at least we hope we're off the pandemic, which has changed the way we live our lives, where we work, whether we work from home or whatever. Has that changed the apparel business? And do you think it's going to last in terms of the effects that it has?
It's definitely changed it because people who sat at home, which I'm not a fan of today, people who were home were dressing casually. The fleece business was wild, and at Alex Mill, we overreacted because we're not a fleece company. But I think that the world is going very much in a different place. And I think the stores and the what was the question again, by the way?
Whether the pandemic is going to permanently change apparel business.
The pandemic has changed it. Casual is now more dress up. People are, when they go out, they're more dressed up. You know, sweats and whatever when you stay home with the kids and the dogs and whatever else. So I think it's a bit more dressy and not sloppy. And there's nothing wrong with sloppy-ish. And that's changed it a lot. The stores, I know you asked about the store business versus online. My little group said they're all up against very tough numbers, so the stores are doing well. I don't know how long that'll last. But in terms of post-pandemic, for us, we're very, and it's kind of been what I do, we're very simple but not basic. We make clothes that are not costumey, and that's our niche, and it has always been style, taste, quality. And I think I keep reading about quiet luxury. I'm not sure I know what that is, but the term is viral now. So I think people are changing, and I think clothes, whatever they say about inflation, the prices of fashion today, they're wildly high. And I think the inflation is whatever the government says, it's still very high. And the designer prices, God bless them, are like you need a mortgage.
I am curious though, Mickey, I mean, when you talk about sort of what the trends are there and you're trying to build a new business or just build out an existing business, are you trying to sort of, I guess, follow the trends, or are you actually trying to be out front setting the trends and hoping that the people follow you?
Well, you can't be behind because then you can't grow. I think every company, maybe in the world, but in America, needs to be creative and create things that no one else is doing. I've never, in my experience, been involved in a trendy company because trend equals it's over. And, the shirt I'm wearing is 15 years old.
Right. But you're wearing what most people would say is kind of classic style, right? You could have bought this 20 years ago. It's still going to look good 20 years in the
shoes.
But is that what people want now? Because you mentioned how sort of some of the fashion trends, and we know there's a whole generation of people, they kind of do want something new every season or every year that maybe looks different than what they had the previous time.
Well, I don't think, I think product. All three most important worldwide in every product company. And I think we were just talking, David and I, about the car designs, and they all seem to come from the same design company with the swoop in the back. And, you have to distinguish yourself from the others. And for us, style, taste, quality, and value for the price. And we only run 2 sales a year. We have a very good one this week.
Okay.
So,
Alex Mill, in case you missed it, right?
Yeah, right, Alex Mill.
But Mickey, you're particularly known for what you did at Gap. Really quite extraordinary. And then at J. Crew. Can that be done again?
Yeah.
Is anyone doing that right now? What does it take to recreate that kind of level of success?
I'm a detective, and I also, Old Navy, I was a detective. You follow clues. And if you're not curious, and if you're not competing against yourself, it's very difficult. Yeah, someone could do something. They can invent something. But it's mostly rearview mirror.
Gap, as I recall, does not have a CEO and hasn't for some time. It looks to be pretty difficult to get people to step into those jobs and do them. Who do they need?
Well, I don't think it's difficult. I think it's difficult to find a qualified merchandiser, product person who does see around corners, who has a certain point of view. And a lot of jobs are filled, as I see it, by people who aren't merchants. And the merchants, they sell goods, and you have to have a vision. And the Gap, which, I loved Gap when I was there, and I still have a lot of friends there, but they need someone to have a vision and put them on course. Now they have 4 businesses. And, focus is critical. With Gap, we had 3. At J. Crew, we had 2. I started Madewell on a curious note. Someone showed me the logo. Then you have to have an imagination. And someone out there will do that. But it's never, obvious. It's not obvious. You dream about it, you imagine it, you spot a white space, or you get a clue from anything. I go through everything as a customer. I see everything through a customer's lens, and I get too many thoughts, and on weekends I kind of have long ideas, and then you got to cut them back and all that. So I think it's tough.
It's tough business. It sure looks like from the outside. I think it's fair to say.
It is a tough business, and being creative is also a tough challenge. And a lot of companies just want to make the numbers, but it's long term.
Not unique to apparel, I suspect. Thank you so much, Mick. Always great to have you here. It's Mickey Drexler. He's chairman and chief investor at Alex Mill. And tomorrow we've got earnings coming out from NASDAQ, actually. So we're going to talk to Dana Freeman about exactly what she's showing up with her new merger that's still pending.
Yeah, and she's been actually very prolific in some of the deals that she's been making, really building out that business. Definitely interested in that. And then later this week, you've got another interesting guest.
Gary Tan, who's Y Combinator CEO, and particularly given what's going on with AI, we're going to talk about the flood of money into AI and how do you figure out where to put it. So that's going to be coming on Friday at 6 p.m. Eastern Time.
All right, be sure to check out Wall Street Week every week and every day at this time. David Weston joins us for our Wall Street Week daily segment as we round up here into the final hour of trading on this Tuesday afternoon. Green across the screen for U.S. equities optimism on the back of some of those earnings reports. Stick with us. This is
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. Live from the Bloomberg Interactive Broker Studio, streaming on YouTube and on Bloomberg Originals. It is Wednesday, July 18th.
It is. No, it's Tuesday.
July
it's Tuesday.
18th. What is wrong with you guys?
You're freaking me out.
Oh, Tuesday. It is Tuesday. Sorry. You know, I had it written down, and I'm like,
I'm like looking around. I'm trying, like, guys, is she right? Did I miss something?
But who said the 15th? Who said the 15th? No. All right, anyway, it is Tuesday, July 18th. Carol Masser along with Matthew Miller. I'll get it straight at some point. Matt, of course, in for Tim. Hey, definitely, no question about it, the Bulls in charge today. It is due to financials and banks and to Microsoft and some of the AI names.
Yeah, mostly to Microsoft, right?
Stop that.
I mean, Microsoft's adding 16 points to the S&P, right?
Yeah, okay.
Morgan Stanley's adding 1.
Oh, stop it. Did you look at all of the banks?
Did
you see
Schwab? If you add up all of the banks, it still won't be as much as Morgan Stanley.
I'm just saying, Matt and I are in a little bit of a battle. Anyway, we're going to talk about banks and financials. They are outperforming in the trade. So is Microsoft, adding a ton to its market cap. We're going to talk a little bit about retail, too.
Yeah, very much looking forward to it after we got those numbers out this morning. And I just saw that David Weston and Romaine Bostick were sitting down with Mickey Drexler,
who
apparently is going by Millard now.
I did not know that.
No more Mickey.
Yeah, interesting. Certainly well-known, man. You go back to the Limited, right, and the retail space. I mean, somebody who was legendary in that place. So maybe we'll talk about that a little bit more. But we're also going to get into the retail data and what it means, and also the surprise indexes.
A big miss on retail, by the way.
Well, it depends how you look at it, right? If you take out, there's some core key metric, and it actually shows some resilient consumer demand. If you kind of dig a little bit deeper.
Gasoline, which is like, I don't know when people take out food and gas.
I'm just telling you.
Take out everything we need to buy, and then I don't care
how economists do it. Anyway, we're also going to tell you about Elon Musk's friend and occasional confidant that he almost put out of business. It's like, yeah, thank you, Elon.
Business is business.
Business is business. We're going to get into BlackRock's interesting board appointee. Matt and I really into this story. And then Lockheed Martin's F-35 fighter jet program. Man, it's had its problems. It's massive. We're going to get into size and scope. And we're also going to talk with the authors of a new book, F-35, The Inside of the Lightning II. Bless you, darling. Oh, he's sneezing. Bless you, bless you.
Excuse me.
All right, we're also going to talk about the untested bacteria-tainted eye drops that blinded and actually killed some Americans.
More bad news from Indian drug makers.
I got to tell you, this story freaked me out.
Awful news.
All right, right now, countdown to the close. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
And right now, this is the countdown to the close. Romaine Bostick alongside Katie Greifeld, joined right now by our colleagues Carol Masser and Matt Miller. We welcome our audiences across Bloomberg Television, Bloomberg Radio, Bloomberg Originals, and our partnership with those folks streaming on YouTube. Interesting day here in the markets. Earlier today, it was all cyclical names. It was all bank stocks. We've seen some catch up with the rest of the space, but I think this is a story where the biggest movers of the day are in those financial spaces.
Yeah, absolutely. Thank you. One from my side. Just wait about this, because Matt and I have been going back and forth. Yeah, let's talk about the banks, because they are definitely outperforming in the trade. You take a look at the KBW. All of the names in the index are up today. You also have the regional bank index rallying as well. Morgan Stanley coming out. Net revenue that beat the average analyst. Sonali Basak talking with the CEO, James Gorman. He was saying fundamentals are strong. At B of A, their earnings soaring. Charles Schwab, their deposits fell, but they say they expect growth by the end of the year. And then PNC rallying, kicking off what we're going to get in terms of a lot of regional banks slash guidance, but adjusted profit did beat. So there's a lot going in this financial sector and some mega outperformance, Matthew.
Yes, so banks are doing well, but they're really not making a difference on the S&P the way Microsoft is, right? If you add up every single bank in the entire benchmark index, they don't even do half of the points that Microsoft. It's adding 16 points by itself with the 5.3% gain, and Morgan Stanley, which is up more than 6%, is adding 0.8 points.
Wow.
So
why does Matt Miller hate banks so much?
I don't. I'm just saying the move is dwarfed by the late day rally in tech, and it's really Microsoft and Nvidia that are lifting this index, adding 20 points to the S&P.
But I would
How much
counter
is it
that
up?
the market's been up most of the day because of banks, right, Katie?
Right. So you guys are fighting. That's what I've gotten so far.
It's like, wow.
Let's talk about retail. Let's talk about Ralph Lauren, because this was really interesting. We had an interview earlier with the CEO. Let's take a listen.
This phenomenon has been going on for a while, that you see this bifurcation of luxury brands that have pricing power, that consumers see the value, and therefore you have the ability to increase your average unit retail, and others where it's just focused on selling product, not engaging the consumer in the same way, much more promotional.
So I know you guys want to keep talking about banks versus AI, but I thought that was really interesting to hear that from Ralph Lauren, saying basically we're going to keep raising prices because we need to boost our brand prestige. And this was really fascinating. The company said that it's raised the average price of its products by around 80% since 2018.
I thought this was interesting. I mean, at least he's honest about it. And I think, and look, let's face it, there are a lot of brands out there that, like that's what they hang their hat on, this idea of exclusivity, or at least the perception of it. And he seems to have a good handle on that. But it raises the question as to, well, are consumers willing to buy into that prestige?
I guess for now, in terms of Ralph Lauren,
how many points is Ralph Lauren contributing to the S&P 500?
0. They're not really making a difference at all.
To be fair, it's 0.011.
But the retail sales number I do think is important, right? Not necessarily the Ralph Lauren story specifically. I'm sure they're taking margin where they can get it. That's what capitalism is all about, right? You're going to raise prices as much as the market will accept. The retail sales number I think is interesting because it was a miss, and this goes to the kind of the slowdown narrative, the growth concerns, and they're pretty evident there. We're not getting GDP, though, until the 27th, so it's another 9 days until it comes out.
All right, and this is why we'll be focused on those consumer companies when they report. We'll see what they have to say about consumer spending. All right, guys, our battle will probably continue, but we will be back with you guys in less than an hour's time. We're going to count you down to the close on this Tuesday. Join us at 4 p.m. Wall Street time for Beyond the Bell, radio, TV, YouTube, and, of course, on Bloomberg Originals.
Just like money in the pocket, baby love. Take that to the bank. I know how to treat a man. With me, you're in good hands, baby love.
All right, guys, we're going to stay with banks for a moment against Matt's wishes.
I'm not saying we shouldn't cover the banks. I'm just saying if you look at what's driving markets today, it is tech.
I would argue both. But anyway, let's get into it, and let's talk a little bit more about what's going on in the bank sector. We talked about the results that we got today from B of A, from Morgan Stanley, from Charles Schwab, PNC. We're going to get more regionals after the close, and also we're going to get Goldman and more regionals tomorrow and throughout the week. Let's get to it with Bloomberg Intelligence Senior Global Banks Analyst Allison Williams. She's on Zoom in New Jersey, and Walter Todd, President and Chief Investment Officer, Greenwood Capital. They have roughly $1.5 billion in assets under management. He is on Zoom from Greenwood, South Carolina. Guys, thank you so much. Allison, kick it off with you first. What was important to you in terms of the banks, the big banks and those that you cover, the results? What did we find out and what really stood out for you, or that we need to have on our radar?
So I think that the net interest income, coming in better than expected across most banks. Wells Fargo talking about the fact that Morgan Stanley is saying that they don't expect expansion in net interest margin in their wealth business, but still coming in a little bit better than expected. And I think it's that the cost of deposits is rising less than some fears. Card income is also helping the big banks on the top line. And then Morgan Stanley also, the wealth flows, which are, it's a business that all banks are in, but it's the biggest business for Morgan Stanley, and really the strength of the flows and getting closer to that wealth pre-tax margin is what was important for that bank.
I feel like, Allison, that's all that the banks care about. Can I be quite honest with you? That's how it feels. It's all about wealth management. And is that fair? I mean, I know it isn't what they only care about, but it's a big, important driver, right?
I think you hear the most about it because it is a long-term secular growth driver, right? And so the majority of businesses for these big banks, right, so they are driven by GDP. They're driven by the economy. It's a big part of the reason why you've seen weakness in the shares for much of the year, just given those economic concerns. And so most of their businesses If you think about how big they are in the U.S., they're GDP cyclical type businesses. However, wealth management is something that globally banks are focused on. There are big opportunities with wealth creation and wealth transfer. And Morgan Stanley has really become a leader in revenue across the U.S. Publicly traded companies through acquisitions. But to be fair, they got there through acquisitions, but they're executing on those with the sizable wealth flows that we saw this quarter.
So, Walter, let me bring you in here and ask what your takeaway was. Net interest income at Morgan Stanley was actually less than we were expecting, right? They had $2 billion of net interest income, and we were looking for $2.3 billion. The banks that we watched last week did a little bit better than we were expecting. So how does that shake out here with rising rates? Are the big banks able to manage?
Yeah, well, good afternoon, Matt. The beard was looking really good. I just want to let you know that.
Shout out to the beard.
Yeah, so I think what you've learned, at least initially in these first few reports here, is that scale matters for the big banks. So it contrasts, say, J.P. Morgan, Bank of America with PNC today. Definitely a different kind of feel to the reporting and the calls in terms of net interest income and then what they're having to pay for deposits. The big banks are still benefiting from not having to pay as much from deposits. That's the bottom line. And going back to the prior discussion on wealth management, I'm obviously in that business, so I think it's a good one. But it's really about banks trying to find non-interest income and diversify away from traditional banking or net interest income. And I think net interest income's going to be a challenge for, if the Fed keeps rates as high as they say they're going to keep them for as long as they say they're going to keep them, this is going to continue to be a problem. And so wealth management is one of those natural non-interest income line items. And if you look at, the house that Gorman built here at Morgan Stanley as he's on his way out, I think the stock really changed because it was down a little bit initially on the report and focusing on that net interest income. But then on the call, Gorman went on this, kind of futuristic view of what they could have in assets under management in the next 5 years. And I think people got really excited about that.
He actually said, he told Sonali Basak in her interview this afternoon that it was a drop the mic quarter. He wanted to drop it and walk away. Allison, he seemed like he really is done. He's ready to retire. How's that going to work out?
Well, I think, as he said with Sonali, he feels that he has set up this business for the successor. They had set out this wealth management target for flows and assets, very aggressive entering the year, and they're exceeding that target, right? So over $200 billion in the first half. That would be annualized $400 billion. It's compared to something like 330 if you broke down the targets equally. So. And I thought it was also interesting that, he talked about the sort of the handoff to a new generation and what that generation might do with the house that he built. And so I think it's the flows, but it's also the profitability, because I think where banks get in trouble is when they only focus on the revenue side. But I think, getting the pre-tax margin up closer to that 30% goal is also a key positive.
Yeah, CEO for 13 years, thinking about kind of what's next here.
There's only two left standing, right?
Yeah, well, but Jamie
Dimon, James Gorman.
Well, but he wasn't there during the crisis.
Ah, true.
Remember, it was John Mack.
That's right.
Yeah.
That's right.
So, what's interesting though, I wonder, guys, the regionals, PNC kicking off. They're kind of a super regional, right? They're the 7th largest U.S. bank overall. So, Walter, they did slash their guidance, but adjusted profit beat the average analyst of estimates. Are we seeing, though, we kind of went into this banking earnings sector, I feel like, oh my God, it's all going to fall apart. And I'm just wondering, is it a case of beating lower expectations in a big way?
Yeah, the old Mark Twain saw, the rumors of my death have been greatly exaggerated. And, I think that's what we're seeing, right? I mean, PNC, again, reacted negatively initially. But on the call, I think the management, I had the opportunity to listen to that call. I think they did a good job of kind of talking through some of the different puts and takes that they're dealing with. But I think in that super regional category, like PNC, like a Truist, they're going to come under more regulatory scrutiny, presumably, and higher cost. Whereas if you go smaller, potentially down the cap scale, you might have companies that are still dealing with the same challenges, but maybe they're excluded from these new set of regulations that are going to come out as a result of the bank failures earlier this year.
I want the two of you who have seen lots of market cycles, and I know, Allison, banks and financials are your big deal. And Walter, you look at the overall market, but Allison, you also, I'm assuming, keep an eye on the broader market. Matt and I are kind of going back about what's really moving the markets today and what really matters. And we've been talking about Microsoft.
Wait, I've showed you with the actual numbers.
Okay, hold on. So banks, right? You look at the KBW, everything's up. You have something like Schwab that's way up, and of course, this is a group that's been battered, and you have Microsoft on a tear. Walter, when you look at this market, be careful what you say. What's important? Is it all important? Are both of these sectors important? How do you see it?
Yeah, I mean, well, technology is obviously the biggest sector, and I will just say Microsoft, just factually, right, and from a pure mathematical standpoint, is bigger in weight than the entire banking complex, then some.
Oh, you dudes with the years just stick together, but go ahead.
Yeah. No, I do think Microsoft, that news kind of definitely gave a shot in the arm to the market earlier today. But I do think financials have been a big laggard, obviously, this year for understandable reasons, and I do think having some respite from that just single focus on technology is good.
Mm-hmm.
It's helpful to the market. But yeah, I mean, I do agree, I guess, with Matt, just from a pure mathematical standpoint, that Microsoft at pushing 7% of the S&P is kind of pushing things along.
All right, Allison, come on in on here. It used to be, we cared a lot about, we still do, about the financial sector, and it was certainly more heavily weighted. But how do you think about that against the broader, trades in the market?
Well, I think there is sort of an old saying that the financials are the quarterback for the market, and again, to the extent that they're an economic indicator of health, it's a positive sign for the market, and certainly I won't doubt the math of technology, driving a certain index, and certainly we all know that it has been technology that's been the strength, and financials that have been the laggard. But I do think that it is, and by the way, I don't think that we're not necessarily out of the woods in terms of, the cost of deposits will keep rising, credit costs will rise, they are normalizing, but I think things coming in a bit better than feared, and I think that, some of the optimism around the financials this morning certainly indicates that perhaps there's less concerns for the broader economy.
Do we call it a draw, Matthew Miller?
No. Microsoft and technology stocks are driving the market higher today. Banks are doing well, but they're just not nearly powerful enough to move.
But most of the momentum for half the day. Anyway, we're going to leave it there.
Okay.
Walter Todd, thank you so much. President and Chief Investment Officer, Greenwood Capital Associates, on Zoom from Greenwood, South Carolina. And our thanks to our own Allison Williams. She's Senior Global Banks Analyst. She's had a busy couple of days here at Bloomberg Intelligence on the phone in New Jersey. Microsoft's important, I agree, but...
Yeah, I mean, it's basically $3 trillion stock.
Okay. Yeah, okay. You're listening and watching Bloomberg Business Week on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We are at the best level of the day right now on the S&P 500 index. Right to the numbers, we're up 36 points at 45.59 for the S&P. A gain right now of 0.8%. The Dow doing a little bit better. It is up now by 1.1%. The Dow higher by 372 points. Nasdaq Composite Index, it is up 138 points, up now by 1%. The Russell 2000, it is up 23 points. That is a gain for the Russell 2000 now of just about 1.2%. 10-year yield, 3.79%, with a 2-year that's yielding 4.76%. Spot gold up $22 the ounce, an advance now of 1.1% to $19.77 the ounce. And West Texas Intermediate crude up 2.1%, $75.71 a barrel. Now, what about fixed income in this market? Kara Murphy is Chief Investment Officer at Kestra Investment Management.
Fixed income is still a really important asset class. You can still build a really great diversified portfolio that will do well over time, but it's hard to kind of draw people out of that very safe place after the volatility that we had last year.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Banks moving higher after earnings. Case in point, Morgan Stanley up 6.4%. Bank of America now up by 4.2%. PNC up 2.1%. Perhaps the big story percentage-wise, Schwab up now by 12.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Matthew Miller. We're sparring a little bit on this Tuesday.
Not happily. I don't like fighting with Carol.
We're never fighting.
I'm not fighting.
We're not fighting. We just we have different opinions. We both have some strong opinions. All right, data surprises by definition, right? They tell market participants and policymakers something they didn't already know about the economy. When we get a surprise, I feel like so little surprises us anymore. The Fed manages us, corporate companies, or rather, manage us when it comes to earnings. But economic data points can surprise us.
Yeah, and they have been a lot lately. I always go to ECSU on the Bloomberg Terminal, which is the economics surprise monitor. But our team at Bloomberg Economics has developed a couple of new daily indicators that reveal how the U.S. data have evolved relative to expectations. And the answer is they're still very positively surprising.
All right, so let's get into it. Stuart Paul, U.S. economist for Bloomberg Economics. He's here in our Bloomberg Interactive Broker Studio. Surprise! No, just kidding. All right, so tell us about what you guys are doing and tell us about these indices.
Absolutely. So we
Can I say indices or do I have to say indexes?
It's actually, so Bloomberg's style is officially indexes.
I know.
Yeah.
And I feel like no one has spread that gospel across the entire company.
My editor hates me for using indices.
Yeah.
I know I should be following the style guide. But
It was like drummed into us for years, and
It's
then every
also,
once in a
you
while.
can just type STYL, go.
All right. More importantly, tell us what you're doing.
So the quantitative research team on Bloomberg Economics rolled out 2 new indexes that offer a bit of insight into, I guess you could say, just how poor the forecasting has been. And the growth surprise index helps to show, it helps to take into account about 67 different indicators. And when we aggregate up the extent of the surprises across all those indicators, it gives us a little bit of insight into the trajectory that the economy is taking. The trajectory relative to expectations, for example. So right now, when we think about the growth index and just how much it's surprised to the upside and how all those 67 indicators in the index have surprised to the upside, if we were to try to just distill it down into one data point, which we've had a lot of surprises in, it would be something on par with the 721,000 jobs surprise to the upside, if we were to try to put it all into payroll space. Now, that's a lot of surprise.
That's massive.
That would be a big surprise. Yeah. So if we're thinking about the totality of the data and just how far off our outlook or just how far off our forecast for the economy has been relative to what's actually materialized, we've been pretty far off. The consensus has been pretty far off, expecting a more rapid deterioration than we've actually seen.
And the models, I mean, it's probably not fair to say this, when she's not here to respond in person. But Anna Wong's model predicted a 100% chance of recession.
Sorry, Anna.
Which is a very high chance of recession. And it hasn't come true yet.
To be fair, it's been the recession people have been calling for like 2 years, and we still haven't seen it. It
That's
feels
right.
like.
Well,
Or
so
a year
that's
and a
right.
half.
It's very difficult when you're trying to train all these quantitative models to forecast things like recession. You're doing it based on definitions and rules of thumbs that typically apply. So, for example, yes, a recession is defined by the NBER's Business Cycle Dating Committee, but a pretty good rule of thumb is when you have 2 quarters of negative real GDP growth. We did have 2 quarters of negative real GDP growth, but it was just a quote-unquote technical recession that wouldn't actually count.
Why?
So,
Can you explain that to me? What
Yeah.
does that mean?
yeah, so if
So
we look at-
technically, we were negative growth.
So what the NBR looks at when it's defining a recession, it's looking at things like industrial production, personal income, less transfer payments, real spending, things, those specific data points, as opposed to just real GDP growth. And real GDP growth can be influenced quarter to quarter by things like declining net exports. And it could be influenced by things like slower inventory accumulation. So if it's the case that consumers are just spending too much or they're spending at a pace faster than U.S. producers can meet that consumption demand, we'll have a drawdown of inventories, and that could lead to that quote-unquote technical recession. But it really just means that domestic demand is robust relative to production capacity.
So the devil's in the detail for a real recession.
Totally.
I mean, a technical recession, right? Because you could define it many different ways. Chances are you and I have a completely different definition of recession.
I'm sure we do.
I like to think of just if you have 2 quarters, consecutive quarters of contraction in GDP, to me,
It's a recession.
That's a recession. But and we had that, right?
Wait, did it feel like that, though, at the beginning of last year?
No, it did not.
Right,
Yeah.
Right, so
and some say we've had a rolling recession, right? We had earnings
And by the way, it didn't
recession,
feel
we
like that to me.
housing recession, like we keep.
Sure.
Yeah.
So, yeah.
Absolutely.
So can I help me here? So these indexes.
Thank you.
You're welcome. How is it helpful as a predictive indicator? Like I'm thinking, you worked at Peter Thiel's hedge fund.
Right.
Like what would you guys look at to figure out growth or slowdowns or opportunities?
So
Economic opportunities.
we'd all still be taking a bottoms-up approach and looking at things like today's retail sales data and thinking about how much that would influence something like consumption in Q2 GDP.
Is it a good report or bad? That's another thing we debated because the headline number one thing and then the key metric says things are better.
Right. So if you were to look at something like the control
Carol's key
group,
metric.
that key metric, the
No.
control group,
Read it on the Bloomberg.
it would look better than the headline would suggest. And yes, I think that you should look at the control group instead of looking at the headline. So I'll agree with you there.
You heard that, Matt?
But here's what I'll also say, is that if you aggregate up the retail sales prints and you're looking at the control group throughout the entire quarter, we do see a step down in the annualized pace of growth from about 5% in Q1 to about 2.1% in Q2.
It's a big drop.
So even though the control group, that key metric in the retail sales report, did relatively well today, throughout the quarter it still looks rather crummy. Or I should just say, worse than it did in Q1.
So are we headed into a recession? What's the chances that we have a soft landing? Because that seems to be the debate right now.
Goldilocks, right?
So when
How
you
many
look at
times people are saying that lately.
Right. So when you look at something like the surprise index, you have to think that the probability of having a soft recession is greater than it was when you were putting in your forecast.
A soft recession? A soft landing or a recession?
Did I say soft recession?
Yes. You did.
Sorry.
Oh, it's so soft.
Well, so this is the thing, right?
Yes.
We are still thinking recession, but we of course have to take into account the fact that our forecasts have been too morose in the past. So a soft landing is of a relatively higher probability than it was when we put in our forecast. But we are still thinking that we're going to have a mild recession beginning in Q4. We could call that our soft recession, the mild recession beginning in Q4, led by things like declines in inventories, declines in fixed investment, which we would consider to be just the typical fluctuation of a business cycle
Right.
and a relatively mild trough.
Right. So again, going back to your indexes, so how does that help us either as a predictive note, in nature, or like how do you use them, or how should we be using them?
So we should be using them to think about the severity or the slope of the trajectory that the economy is going to take over the foreseeable future. We've had too steep of a downward decline baked into our forecast, and when we have these surprises to the upside, we have to think, okay, it's going to be a slower burn at a minimum as we head into that recession in the later part of this year.
Can an index like this change dramatically?
If you end up, sure, for example, if you were to have something like a 721,000 job
Drop.
surprise.
To the upside or downside?
To the upside or downside, you would again have that sort of same draw up or down in the index itself.
By the way, we're talking for the most part about the growth surprises, right? But
Correct.
you've got two indexes that you've put together. The other one is inflation surprises, which
That's
has been off the charts compared to growth surprises, right?
That's right.
And still is elevated. Still one standard deviation higher than, I guess, the survey or the expectation. So does that trajectory look like it's going to continue to come down to you as well?
Right. So the thing to keep in mind is both the level of the surprise and the direction of the surprise. Similar to when we're thinking about something like inflation itself, yes, inflation is still running hot, but it's coming down, right? So when we're thinking about the surprise index, the thing to keep in mind is that we're becoming less bad at forecasting inflation. And as we've been, I guess you could say, improving our forecast for inflation, we would also expect that the pace of inflation is going to be slowing.
That's what I was going to say. It's like in terms of people predicting, right? Their ability to.
That's right. When we sort of get into a more normal range of estimates and a more normal range of data, it becomes easier to predict that data itself.
Well, come back soon. This was really fun. Stuart Paul, U.S. economist.
For Bloomberg Economics, and he now
Thank you.
coined the term soft recession, which we're going to start using.
All right, let's get a check on world and national news. Dan Schwartzman, take it away.
Thanks, Carol Ann. Matt, as you've been hearing on Bloomberg Radio, former President Trump has been informed by letter from Special Counsel Jack Smith he is a target of the investigation into efforts to overturn the results of the 2020 presidential election. Trump could be facing yet another indictment, as letters of this nature are usually sent to those facing the prospect of indictment. Trump was indicted last month and pled not guilty to 37 criminal counts related to his handling of classified documents. Trump also pled not guilty to a 34-count indictment from the Manhattan Attorney General's office for allegedly falsifying business records in connection to a hush money payment made to porn star Stormy Daniels. A U.S. soldier is being held in North Korea after seemingly willingly crossing the border. Bloomberg's Nathan Hager reports from Washington.
The United Nations agency in charge of Korean border security says a U.S. national crossed in from South Korea while touring the joint security area. That's part of the border zone that is closely guarded by both countries' militaries. Democratic Congresswoman Alyssa Slotkin visited that zone with a congressional delegation in 2021. She tells CNN it is one of the most constrained areas in the world, and it is not likely someone could have mistakenly wandered off. The UN says it is working with North Korea's military to resolve the incident. In Washington, I'm Nathan Hager, Bloomberg Radio.
Thanks, Nathan. The soldier has been identified as Private Second Class Travis King. Florida Governor and Republican presidential hopeful Ron DeSantis has filed paperwork in South Carolina for the Republican primary. DeSantis is in the state for a third time and rolled out his plans to reform the U.S. military, which he believes has gotten too woke. DeSantis also saying he would offer military personnel who lost their jobs for refusing the COVID vaccine a chance to return to their positions with back pay. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg.
auction lost.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long at Bloomberg. We've got 20 minutes to go until the closing bell on Wall Street with the Dow, the S&P, NASDAQ very close to session highs. Let's head right over to the first word breaking news desk for today's afternoon call. And here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks with a bid today, helped by a big intraday move in Microsoft. Dow's currently up 372 points. S&P's gained 36, and NASDAQ is higher by 132 points. The U.S. 10-year yield is at 3.79%. Gold is up 22. Oil is climbing, but Bitcoin is down by 0.5%. Among the main 11 S&P sectors, leaders were tech and energy. Utilities were under pressure, and leaders to the upside in the Dow, Microsoft, UNH, and Goldman Sachs, while Honeywell and Visa led to the downside. And speaking of Microsoft, it traded to a record high after setting prices for its new AI products. After earnings, Schwab soared 12%. Morgan Stanley climbed 6%. Wrapping things up, Interactive Brokers and JB Hunt report after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type Squawk, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got Just under 18 minutes left in today's trading session on this Tuesday, July 18th. Carol Massar along with Matt Miller. Matt, of course, in for Tim here on Bloomberg Business Week. I want to get to the markets. We've definitely got a rally underway, just hovering at our best levels of this session on the S&P and Dow and NASDAQ. Charlie just breaking down those numbers. With us is Mace McCain, Chief Investment Officer at Frost Investment Advisors, a wholly owned subsidiary of Frost Bank. They offer diversified mutual funds and investment advisory services for institutional, family office, and individual clients. He is with us on Zoom from San Antonio, Texas. Mace, thank you for being with us here on Bloomberg Business Week. You know, you're there in Texas, and I want to kind of start with a story that has kind of obsessed a little bit of us, Matt and me, about BlackRock. And putting Saudi Aramco, their CEO, right on their board. And the role of fossil fuels, there you are in Texas. How do you think about the role of fossil fuels as important to keeping everything moving on an energy basis, but also as an investment play?
Of course, we have a lot of clients that are invested in the oil and gas business, both owning production and also drilling and oil and gas companies. So they're critical to us and on the investment side. Our view is that this is going to be a transition and that we're going to need fossil fuels. We're going to need the production of oil and gas, especially gas in this transition. And so that is a longer-term move, and that we've probably underinvested in the space, and so we're going to continue to see higher prices.
So, Mace, isn't this good for you and your clients when the boss of the largest financial institution in the world goes from preaching ESG to putting the head of the biggest oil producer in the world on his board?
I think it's a realistic approach. I think that we need to manage the transition for the economy, for the Texas economy, for the U.S. economy, and that we're not ready to just go flip the switch and not have oil and gas. So I think that involving the industry in this transition and working forward on it is the perfect way to move forward.
All right, so let's take an even bigger step back here and talk to us a little bit about the trade that we are seeing here when it comes to equities. The rally continues, propelled by the likes of Microsoft and some other AI names today, as well as the big banks and some other financials. Is this an opportunistic market that you want to buy into, or are you finding you're selling more names and feeling like, I've had some pretty good gains this year. It's time to, I hate to say it, take money off the table?
We are doing just that. We're not so much taking money off the table, we're taking gains and rebalancing back. I think that, we saw, if you look at the Bloomberg Surprise Index, Economic Surprise Index.
We just talked about that on air. That's very funny.
It's been very strong. We entered this year, the short interest is up. The put-call ratio was showing people were very negative. And the Bloomberg Surprise Index has been a good indicator of how much positive economic news we've had. And so there was a lot of short covering, a lot of people afraid of missing out, and a lot of money pouring in. And I think it along with AI, has led to this rally. But it's broadened beyond AI. We've seen in the last few weeks broadening in the market.
So can I ask you just to follow on that Bloomberg Economics Growth Surprise Index? So when you start to see a change in terms of an uptick, you see that as opportunistic and maybe an indicator that things are too negative and an opportunity to buy in, at least on the equity side. Yeah.
I would agree. In the short term, things are way too negative, and the surprises caught everybody without enough equity exposure. At this point, though, with this rally, especially in the growth stocks, we're rebalancing back. We've been through an incredible Fed rate increase cycle, and we don't typically get out of these unscathed. The majority of them end up with recessions, so at some point. So we're still cautious. We're equal weighted to stocks today because we don't want to fade the rally yet. But we're much more interested in putting money on the bond side. We think it's time to spend some of the cash and lengthened duration of bond portfolios.
That's interesting. So it's time to go out on the curve right now while you're getting, 4% returns, and you think that you'll get capital appreciation there as well, right? Because if you do it now, you're going to be a first mover.
We are, and especially if we're seeing any sort of turmoil in the bond market. If we're seeing bonds selling off, we're definitely buying and moving out on the curve. So I think it's that time to do it, and we're being more aggressive and as we rebalance these portfolios. I think there's way too much money in cash. People are comfortable there, and I don't think a lot of people, especially on the retail side, think about reinvestment risk. But I think the reinvestment risk is developing on that cash.
Where don't you want to be?
Commercial real estate, especially on the office space. I think that's got a long way to go. And so that's something we're avoiding. But in the other alternative spaces, we're still opportunistically looking at vintage returns and pretty excited about investing. But as I said, we are selling some of the big gains in tech or rebalancing back down to our original positions.
Selling Microsoft, perhaps?
Back to target positions. We're willing to take some of those gains off the table.
What do you think about the popularity of private credit? Carol and I talk about it a lot, and really for the last year, I've been hearing people get more and more excited. I spoke with a guy who has started a platform to allow retail investors to get in. Is this a hot space for you as well?
It is. It's one of the, if I were to isolate an area that I like the best, it'd probably be private credit. I think that the vintages that they're creating, the new funds being created this year, have amazing opportunities. That area is tightening up, as we've talked about in the past. We've seen tightening in the bank credit market, and the banks continue to tighten. So the spreads available in private credit are getting better and better. And so I think that funds that are investing today and startups are going to have very good vintage returns from this year and into next year.
No worries about credit quality within those portfolios? Not a lot of transparency, and just got about 15, 20 seconds here.
There are a lot of good advisors out there that when we select a credit fund, we look at somebody that survived in 2008 and 2009 and did a good job in managing credit risk. And if you go with a good advisor and you can get into the select funds, I feel very confident about what the returns will be.
Mace McCain, thank you so much. Chief Investment Officer at Frost Investment Advisors on Zoom from San Antonio, Texas. This is Bloomberg.
York company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Morgan Stanley shares are rallying. They're up the most in 6 months after company executives said the worst may be over for the firm's trading and investment banking slump. CEO James Gorman spoke with Bloomberg Radio about the quarter.
We had some big movements in the stock when it was very low back in 12 and 14 and 16, 2012, 14, 16. No, but today's big, but it's just reflective of the fundamentals are really strong. Our capital ratios, I mean, we'll see when all the banks report. We're close to the end of the major banks, but I'm pretty sure we've got the highest capital levels of any bank, any major bank in the U.S.
And Morgan Stanley shares up right now by 6.2%. You can hear more with James Gorman on the Sound On podcast. You can download it wherever you get your podcasts. Bank of America after earnings up now by 4.4%. David George is a senior bank analyst at Robert W. Baird.
Sentiment towards banks over the last couple of months in this so-called banking crisis that market participants are worried about, yet these bank earnings look pretty good. Bank of America made, as you mentioned, almost $7.5 billion in just the last 3 months. In light of a challenging economy, a lot of concerns about credit, particularly on the commercial real estate side of things, and B of A continues to execute well. And as Brian Moynihan said, I think controlling the things that they can control was really very well said by him. And bank earnings so far have been so good.
And right now, Bank of America up by 4.4%. Schwab after earnings up 12.3%. Those are our top company stories, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
All right, everybody. Carol Messer along with Matt Miller in for Tim Stenivek here on Bloomberg Business Week in our interactive broker studio at Bloomberg headquarters in the lovely New York City. It's a little overcast.
I mean, the weather's not great today, but it's a great city.
It's a great city. I feel like you and I are having a show within a show today. We're having a show off air, debating and talking about a lot of stuff, as well as the stuff that's going on. Having said that, where shall we go?
Meta
let's
Platforms is making its artificial intelligence large language model, which is called Llama 2, by the way.
Dun, dun, dun.
I love the name because it's like happy llama, sad llama, totally rad llama.
Very sweet.
Anyway, it's the Meta AI model is going to be available for commercial use, and it's established a partnership with Microsoft to use Microsoft's cloud.
Is there the Mama Llama books? Is that what you're doing right now?
This is a camp song that we've had it.
No, but there's Mama Llama books too.
I didn't know that, but there's anyway. No,
a Netflix series, children's books.
I haven't.
See the rabbit hole.
That.
See the llama hole that you just created.
Yes.
Okay, go ahead.
Well, I think this is one of the most important stories of the day because Facebook, Meta, is going to use Microsoft's cloud to sell its AI product. And this is like what Microsoft does now. It's not really about Windows. I was talking to an analyst earlier, and I said,
the cloud?
It's going to be cool for consumers to use co-pilots. And he's like, yeah, maybe it's cool for you, but that's not what we care about.
Cloud.
We care about the cloud business. We care about their enterprise business. We care about B2B.
Yeah,
you know?
Exactly. I mean, this is where everything gets stored, everything gets done. I mean, I feel like ever since AWS, right, the world of cloud, that's what it's been such a momentum for so many different tech companies. So, and it's something that we're going to be thinking about on the call. It's also why people say on the earnings call when Microsoft reports, but it's also why when people think about AI, right, they're like, I don't really care what individual companies do with it. I care about how they do it and where they store it, right? All that data to make AI, generative AI, smarter. They're all going to be having to use processing and the cloud.
Yeah, no, absolutely. I think, there's an analogy to be made about a gold rush and shovels. I just don't have it quite yet in my head.
Llama, llama, mad at mama.
Happy llama, sad llama, totally rad llama.
Llama, llama, mad at mama.
Super llama, drama llama, big fat mama llama. That's how it goes.
All right, folks. Counting you down to the close right now, Beyond the Bell with TV and radio starts now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu, joined now by our colleagues Matt Miller and Carol Massar, we're counting you down to the closing bell. Here to take us beyond the bell. I'm all confused today, Carol Massar. I mean, the words are right there in front of me, but you know what? I just get so caught up in just your wisdom and just the grace presence that you and Matt Miller bring to the table every day. Yeah.
No, so only kidding.
I don't buy it.
Love it, love it, love it. We're not that easy. We're not that easy. Interesting market, right? I mean, it just feels like investors are willing to buy into it, whether it's some of the big tech names. Dow, though, the outperformer, so I'm not sure what that tells us, Matt.
Yeah, that
Among
is
the major
interesting,
indices.
actually. I hadn't even noticed that because I don't tend to look at it that
my
much.
wisdom, as Romaine
But you're right, the
Bostic
Dow's
pointed
up 362 points, more than 1%, and the S&P and the NASDAQ are only up about 0.75%. It is really a story of the banks giving some optimism to the trade this morning, and then I think a handoff, is that a better way to put it? A handoff to tech with the Meta Microsoft announcement on AI that really continued to drive markets higher.
And better breadth overall. You have the Dow Industrials and the Russell 2000 outperforming the S&P 500 and the NASDAQ, which is what everyone said you needed to see in order for this rally to be a little bit more sustainable, the participation of these unloved stocks.
Yeah, absolutely. I mean, we talk about this idea of getting that breadth here, and I know, Matt, you were sort of poo-pooing a little bit earlier some of the advances in the bank stocks because they weren't necessarily the big point contributors here, but you go through the big percentage gainers here on the day, and we're not talking about AI. We're not necessarily talking about big tech. We're talking about material stocks. We're talking about healthcare stocks. We're talking about financials, and I think for some folks, that's a good thing.
Romaine, can I just say I adore you? Thank you for saying that.
Thank you very much.
You're welcome.
And you know, and we just, I mean, just real quick, let's get through the bells here. We do get the Dow Jones Industrial Average, and we should point out, not just outperformance on the day, up 1% on the day, about 360 points, right around that 35,000 level. It's on a 7-day win streak. This is the longest win streak for Dow Industrials going back to early 2021. The S&P 500 up about 0.7% on the day, now firmly above that 4,500 level. And then you go over on the board here to the NASDAQ Composite, 7 to 0.8% here. So we're talking again, a broad-based rally. You flip it up, you look at the Russell 2000, a gain of 1.3% on the day. Transport's up 2% on the day here. So look, there's a lot to nitpick over, but overall, if you just take it at face value, this was a good day.
Yeah, absolutely. Optimism and risk on in a lot of different sectors. I'm going to go back to the big banks, if I may. In the bank sector overall, just looking at the KBW going there, all 24 names, Matt, finishing higher for the day, and that index up more than 3% in the trade.
Taking a look at the groups that are up, obviously IT is the biggest gainer in terms of the industry groups here, but you do have financials close on their heels, up more than 1%. Energy also up about 1%. In terms of the losers, retail, utilities, and consumer staples. So a real differentiation there between defensive and aggressive stocks. Is that fair?
I don't know that they get
I think
aggressive.
that's called growth, right?
Yeah.
Yes, thank you, growth.
Okay.
Yeah, okay. They went to therapy.
The
They
growthier
went from
stocks.
aggressive to being growth.
By the way, it's so
They
cool
did.
that the
Aggressive just
transports are up
sounds, I don't know.
2%. Do you know who taught me about Dow transportation theory? Was Carol, like 20 years ago.
Did I do?
Yeah.
In the sandbox, right?
Dow theory.
All right, let's get to it. All right.
That's funny.
Let's get to some of the individual gainers. Let's talk about the banks. Charles Schwab, number one gainer in the S&P 500, just finishing off its highs, up about 12.5%. Executives there suggesting the worst is over for the brokerage. We know we saw this with the regional bank meltdown, if you will, or fallout, and that certainly weighed on Charles Schwab as well. But nonetheless, number one in the S&P 500, again, up 12.5%. Morgan Stanley, number three gainer in the S&P 500, up 6.5%, following its results. Company really wealth management and outperformer for that company. That really kind of weighed over the slump that they saw in investment banking. Then you've got Microsoft, my gift to Matt Miller today, up about 4% off its highs of the session, but I believe hitting a record high, certainly intraday, and I think possibly...
Yeah, it did close at a record high, yeah.
Thank you. So Microsoft up just about 4% in today's session, coming out, giving pricing details for its corporate artificial intelligence tools, if you will. And then I just do want to mention Old Dominion. It was up about 2.8%. We saw a rally in a lot of the LTL transportation companies. You saw this, Cowen, concerns about Yellow Corporation, maybe a dispute with the Teamsters.
Yeah, and we should point out that news broke just in the last hour. Those Teamsters at Yellow did vote to actually strike here, which I think is set to begin on the 24th. And of course, the assumption is a lot of business will move to the other less than truckload carriers.
Yeah, Dominion, XPO, and Saia all gaining in today's session.
Yeah, labor disputes increasingly becoming a theme in this economy. economy. Let's take a look at some of the decliners. Prologis is one of the worst performers in the S&P 500. The industrial landlord opened higher on better than expected top line and bottom lines, but it quickly erased its gain after second quarter results showed occupancy falling below analyst estimates. And Visa and MasterCard both down about 1%. The pair face a new antitrust lawsuit alleging that they conspired to vastly overcharge the Square payment platform, and that resulted in higher retail prices paid by consumers. The suit was filed on July 14th. And Massimo, which is a hospital equipment maker, plunging 20% after pre-announcing its second quarter revenue missed analyst estimates due to delayed orders, lower than expected U.S. hospital inpatient flow, and strained hospital budgets.
Let's get a quick check on what's going on in the yield space. Not a whole lot going on for a change there. Your two-year yield slightly higher here on the day by about 1 to 2 basis points. And then to the downside, you're looking at about 1 to 2 basis points on the 10, the 20, and the 30-year yield. Put it all together, and basically we kind of remain unchanged, at least on the trajectory of that yield curve.
All right, so do we want to mention Omnicom earnings?
Yeah, let's. I mean, we do have a couple of kind of secondary earnings. I've been keeping an eye on Omnicom, which is a big kind of advertising, commercialization platform. Their earnings are out. The shares are down. The 2Q numbers on an EPS basis looks like they did beat $1.81. The street was looking for $1.79, but the revenue numbers coming in a little bit light, guys, at about $3.61 billion. The street, on average, was looking for about 3.7.
Yeah, and Romain, it's a stock that would have hit, a 52-week high in today's session. It's up about 20% for the year, but as you mentioned, we're seeing some pressure in the aftermarket now, down about 5%, Matt.
Yeah, so we'll continue to follow any of these earnings when they break. Romain, as you say, they're not any huge companies scheduled to come out right now, but we're at the beginning of earnings season, so we're going to start seeing a slew of these come across the ticker.
Yeah, and just real quickly too on Omnicom, because one reason I looked, everyone's concerned about ad spending, right? We saw a Trade Desk, which was down today, but then you had that upgrade on Pinterest, which was that sell-side analyst was basically making the case that there is a lot of digital ad upside, at least for certain companies out there here. So, I mean, I guess this is probably dating myself, but when I started my career, one of the sort of economic tea leaves you always looked at was ad spending, because it was kind of an indicator maybe of where businesses at least felt the economy was going. I think it's
still the case.
We have the numbers for what happened in the quarter that just ended, but really the outlook is going to be critical here because this is what companies are planning for in terms of spending and how they're going to budget for the rest of the year, for early next year. And cost cutting is very much the theme, and that's helping drive a lot of the
There's
results.
more earnings out. You like trucks, Matt?
JB Hunt, yeah.
Always.
You know I like trucks.
Maybe Scarlett and I like trucks.
Okay, well, sure. Well, you want to go for it?
Do you like trucks?
No, she's not ready. Carol Masser, 181 on 2Q EPS for JB Hunt. That's a miss. Operating revenue coming in at $3.13 billion. That's a miss. Intermodal revenue coming in at $1.49 billion. That's a miss. And dedicated revenue coming in at $88.7 million. That's also a miss. Shares down 2%.
That's interesting. So my takeaway from this, JB Hunt management does not know how to guide analysts. Because you've got to push your analysts down if you're going to miss those numbers.
They should have been doing it in the weeks leading up to this so that by the time they came in, they were beating a lowered bar.
They should hire Goldman Sachs.
What's the visibility, though? I mean, because I mean, it's easy to say, okay, they should have done this, right? But we talk about just how hard it is to read this economy, right? You get an economic data point on one day that shows strength, and then the next day you get something that shows weakness. How much does that complicate what these CEOs and CFOs have to forecast?
It's so funny that you say that. We were just talking with Mace McCain. He's over at Frost Investment Advisors. He looks at the Bloomberg Economics Growth Data Surprise Index, which has shown how data has, for a long time, for several months now, continued to surprise to the upside. We're kind of just turning over the top of that, but he has used as an indicator about kind of when to get into the market. But he kind of feels like, right at this point, Matt, maybe pulling back on some of those growth stories because he thinks maybe we've seen some of the best data points.
He's taken some of those profits, and he wants to move into fixed income, and he wants to move at the curve. So I think that's what we're hearing from a lot of investment advisors lately.
You also wonder how much these CFOs think that they can maybe move things around and make the numbers look a little bit better in the early days of the new quarter as they finalize their numbers, right? I mean, they have visibility in terms of how things ended in the quarter, but they have room to kind of play around in terms of whether they're going to make a charge for something, right?
Yeah, well, yeah, most of them do, and it'll be interesting. I think, Matt, you were just kind of Matt or Carol, you were just referencing kind of whether you sandbag or whether you sort of set the bar low so you can move to the upside. I don't know if that was in reference to Goldman specifically, but we get those earnings tomorrow, and that was all the discussion last week, that story saying that they're basically kind of softly guiding people lower. And was that significant, or was this them just really just trying to prime the pump?
Exactly. It's a really good point. I just want to mention John Wren, CEO of at Omnicom, while the balance of the year will continue to see economic uncertainty. And then he says more things. So getting a little bit in terms of his thoughts on the outlook.
More things.
More things.
I mean, when haven't we seen economic uncertainty going forward? When was the last time you heard a CEO say our visibility is fantastic?
Banks mattered today. Right, guys? Banks mattered today.
Does Matt know that? Matt doesn't.
I agree that banks matter.
He hates banks.
I know. Why does he hate on
Carol's trying to draw me into this, and Romaine, you're egging her on.
All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. Thanks for joining us. We will see you again tomorrow.
There's a new kid in town. Everybody loves him, don't they?
I'm so glad we're getting to this story. What's the matter? Are you okay?
I'm okay.
I know you.
I'm glad we're getting to it also. This is one of those stories.
You're like having one of my brothers in here. It's like just so much fun.
Thank you very much.
You're very welcome.
I love to be people's brother. This is one of those stories where I think I saw it on Daybreak this morning.
Yeah.
And
well, we got some of it yesterday, didn't we? Late yesterday.
Maybe some of it came out yesterday, but I didn't see it because I was like putting a 2-year-old to bed. But I saw it this morning, very early.
Okay.
And I sent it straight to the team because, you know, BlackRock is the largest financial institution in the world,
Asset
right?
manager,
I mean, $10 trillion or maybe more now in assets under management. And Larry Fink has been pushing this ESG narrative. He's kind of been, the leader of this fight.
But he won't use it anymore because he's gotten so politicized.
Well, not only won't he use it anymore, but now he's put the CEO of the biggest oil producer in the world on his board. It's like doing a 180 in some ways. Now, I understand how
he's
it could be
still a
interpreted
proponent, though.
differently.
He still says he's a proponent of ESG. I'm just telling you.
Right, but did you hear what I said? He just put the CEO of Saudi Aramco on his board.
Too bad we don't have Larry here to ask him about that. Who we do have to ask about it, though, is Sela Brush. He is Bloomberg News financial regulation reporter here in our Bloomberg Interactive Brokers studio. We are obsessed with this story. It is just interesting. We're trying to make sense of it. So tell us about the news and the significance of it.
So this was late yesterday after the market, and it was an announcement of a new board member to BlackRock. And yeah, it was a surprise. This is putting on the board of BlackRock the CEO of the world's largest oil producer, Aramco.
Heard of it.
Effective immediately. It's not the first person from the Gulf or from Saudi Arabia on the board. In fact, the person who's already there in the Gulf is going to be stepping off and next year not standing for re-election.
I thought actually that was interesting because I didn't think about that or realize that. But anyway, go ahead.
And I think, BlackRock has been an incredibly vocal supporter, and Larry Fink specifically, of sustainable investing, ESG more widely known. And I think what we've seen over the last maybe 6 months to a year is certainly, from the middle of last year, this really intense political debate, especially in America, about ESG, the role of investment managers to channel capital towards things that are environmental, social, and governance related. And they've really become Exhibit A, the firm, in that pushback. And they've gotten it from both sides, really, from liberals and Democrats who think that the company doesn't do enough, doesn't essentially channel money away from fossil fuels enough, and from Republicans and conservatives who think that the company is perpetuating and sort of woke ideals and imposing social values on the rest of society. And so I think over the last year, the company has talked a lot more about transition capital, investing money in a way that helps companies move to a low carbon future, and has tried to essentially not use the rhetoric ESG and not talk about sort of social values. And I think we've certainly seen that very clearly recently from Fink.
He went on Fox. That's all you need to say, right?
Went on Fox, and he did a couple appearances recently in which he's talked about ESG being quote unquote weaponized and being no longer a term that he uses, things that it's been so highly politicized that it's basically a distraction, irrelevant, just not something he's going to try
I mean,
to use.
anytime someone uses the term woke or the term weaponized, I know that it's going to be a political discussion right away. I would discount those two terms. The interesting thing to me is, and you have this in your story, Ulf Erlandsson, who's the CEO of the Anthropocene Fixed Income Institute, says there's going to be a lot of investors at BlackRock who purposely exclude Aramco from their funds. And yet they're investing with a company that has the CEO of Aramco on the board.
It's going to be really interesting to see if there's some pushback that carries forward not only to products that people use, BlackRock products that clients put money into, but in terms of their view about using BlackRock. Is there any sort of knock-on effect? BlackRock is the world's largest asset manager. It's 9.4 trillion is the current stat, and I think they have products across the range of the most basic index fund to things that are highly targeted. And I think that's a piece of the message and a piece of their positioning over the last year, that they've tried to, to some success, some troubles, try to emphasize that they're essentially offering choice to whoever wants to invest in nearly anything. For those criticisms, for the critics of the firm, will they pull money or will they steer investments in a different way? I mean, TBD, right? Always. But, back to the ESG debate in America, there were a lot of criticisms of BlackRock, and some states and Republican officials in states across the country, they did pull money, not a lot by the standards of BlackRock, but $3-4 billion, so nothing either. And so I think it just goes to show that the company is essentially facing criticism from both sides.
You can't win.
It's again, they offer products across the board in all markets, a real range of investments, and the company has been such a vocal proponent of responding to climate change, allowing people to channel their money in whichever way they want, that they're ripe for criticism.
But okay, devil's advocate a little bit. I mean, many of these energy companies, right, they are looking at what the future of their business is. Now, it might not be tomorrow, it might not be 5 years, it might not be 10, might not be 20. But the carbon capture, right, or the investments in pipelines of carbon capture and some different, they're all making initiatives. I mean, I remember a National Geographic when I was a kid, or younger, I should say, maybe high school or so, and it was like the Middle East was looking at alternative energy because they understand it's a fixed commodity, right? At some point, it runs out. Yeah. So we had National Geographic.
That's great.
You're looking at me funny. But I guess my point is, is it smart also for Larry Fink to have somebody like this who really understands the energy space on his board and the changing dynamics?
I think that is, by his telling that he wants somebody on the board. Those were his comments yesterday, that he essentially wants somebody on the board who does have, I think his words were, unique perspectives on energy issues facing both the company as well as clients. And you're right, of course, that big oil majors or the natural gas companies, it's not like all of them are steadfast against the concept of climate change, right? Like, they have their own plans, they put them in place. It is a long time horizon, and I think that is one of the central challenges with this entire debate. Is it can't probably be solved tomorrow. It is a matter of decades, and so that's why the discussion about it, or at least the terms and the words that are thrown around so much more, are about transition capital. You can't go from brown to green overnight. It's sort of shades of green. That's the sort of like the terminology of the debate has shifted. Not always and not for everyone, and that's where you get the political blowback.
It's also, I mean, the Middle East has become the world's provider of marginal capital, right? I mean, they're it. Mm-hmm. So it's got to be, in a way, as you said, they already have Saudis or a Saudi on the board, but still, this is a way to show that they're dedicated and are going to continue.
They've been in the region for a long time. Yeah. They've showed up at conferences, Larry Fink for sure. the company manages money on behalf of sovereign wealth funds and big investment vehicles that invest around the world, and so they are major, as you said, they're major sources of capital.
It does feel like the Middle East money is just kind of everywhere all of a sudden. So thank you so much. So
Thank you.
Financial regulations reporter at Bloomberg News in our studio.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yeah, it's 4:21 on Wall Street. We do check markets all day long here at Bloomberg as we monitor bank earnings. We had the S&P 500 index up 32 points today, a gain of 0.7%. Dow Industrials up 366, a gain of 1.1%. NASDAQ rallied 108 points today, up by about 0.8%. The Russell 2000, as the rally widens, up today by 1.3%. Bank earnings, though, the big story. Bank of America after earnings rallying today by 4.4%. Morgan Stanley after earnings up 6.5%. Schwab Corp up today by 12.6%. PNC Financial up by 2.5%. Also, we saw a rally in stocks linked to artificial intelligence. Case in point, Microsoft ending the day with a 4% gain. Microsoft now at a record 10-year yield, 3.78%, with the 2-year yielding 4.75%. Spot gold up $23 the ounce to $19.78, a gain of 1.2%. And West Texas Intermediate crude up 2.1%, $75.68 a barrel. So again, recapping, the Dow, the S&P, NASDAQ, all higher today. S&P up 32. That was a gain of 0.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie, thank you so much. Well, this story last week was a most read, definitely got our attention. It was about the friend of Elon Musk, a serial entrepreneur, founder of the auto fintech startup Fair, the auto pricing service TrueCare, and auto shopping portal Cars Direct. Also the founder of Autonomy, a subscription car service offering up Teslas and Chevy Bolts, which got a jolt when Elon started slashing the prices of his cars. It's like, Elon, what are you doing?
Yeah, absolutely. I mean, I thought it was a great story because the two are friends, you know, and I've been following Scott Painter almost as long as I followed Elon. In fact, I think Scott Painter introduced me to Elon Musk like over a decade ago.
All right.
But, you know,
pretty cool.
it's a bummer when Scott has invested so much money into something, then Elon slashes prices at Tesla, and then that hits Scott right in the pocketbook.
It's kind of a wait what moment. All right, so let's get to it because lucky for us, Scott is with us. Scott Painter, as we said, founder of So Much, on Zoom from Santa Monica, California. Bloomberg News EV reporter Sean O'Kane, who wrote this story about Scott and brought it to our attention, joining us on the phone in Austin, Texas. First of all, Sean, just set it up for us. How did Scott and his story come on your radar?
Well, you know, I think they've been dealing with some trouble, as Scott, you know, is willing to admit in the early part of this year following those price cuts. And so they were going through a run of different options as far as how they could keep moving this business forward. They always had pretty big ambitions. Last year, they announced they wanted to have, you know, a fleet of 23,000 electric vehicles available for subscription. So, you know, they had gone sort of quiet, I think, a little bit, it's fair to say, in the early part of the year after they started to run into some of that trouble. And they also needed to put their heads down and, you know, come up with a plan with their lenders and with their shareholders and with any potential new investors. And so last month, they were finally ready to start talking about what it took to get through that and where they're looking to go this year, which I found really interesting because, you know, we've all heard so many stories about how things have shifted in a interest rate environment that's choppy at best, and so this is an even more interesting thing that they're going to have to deal with, and I think it's a unique story.
So, Scott, jump in here and talk to us about your business because surely the price cutting move by Elon was not at all personal. It was a purely business decision on his part for Tesla, but what made it a little bit more difficult for you to move ahead, didn't it?
Well, you know, I think we're living through a pretty historic moment. It's clear that we're all going to be driving electric cars, but everything about this transformation to electric vehicles represents a shift in how we think about financing the business and managing these fleets of cars. And so while Tesla made its decision completely for the right reasons for Tesla to make sure that it continue to be able to deliver cars to customers at pace, despite the fact that the Inflation Reduction Act had a little bit of a stagger towards the end of the year. Tesla also made a very big shift moving from build to order to sell from inventory. They are now producing at scale. And so all of these things represented just a completely new set of variables for lenders that provided debt to companies like ours. And so I would say that, you know, the footnote on this story is that the key for us was survival. You know, we run a fleet of just over 1,200 cars. And just to put things in context, you've got 330 million cars on American roads. Less than 3 million of those cars are currently electric cars. So there is a massive imbalance between the number of electric used cars for sale versus ICE vehicles that are for sale. And that used car market matters a great deal for us. We are an asset-backed business where we buy these cars, provide them to customers on a flexible, open-ended term, and it allows them to get access to the car. And the two big value propositions that we deliver, especially in a market where interest rates are going up, is cheaper and easier. Because we're not selling customers cars and because we're not lending anybody money, 100% of what we do happens on your smartphone. And that's a really big transformational moment. And that means that we own the car, and lenders historically have never financed cars in those types of short-term contracts. And so they really don't have any point of reference for understanding what happens when an automaker like Tesla cuts 20% of the price of a car. But it wasn't just that price cut. It was also that customers who had been waiting 9 months for a car could all of a sudden get the discounted car in 5 days. And so what that did is it took pressure off of the used car market. And all of a sudden, what was a premium for a used electric vehicle, a Tesla Model 3 in November of last year was selling for about 15% more than a brand new one. And that's just a byproduct of scarcity. That immediately reversed course. And we're not selling our fleet. We are using these cars. And so in reality, this shift didn't represent a real change in the value of the assets that we owned, but it did represent a real shock to how our lenders thought about it. And today, on the other side of that, we're much more prepared. We're a much more durable business. We do anticipate that Tesla is not going to be the only one that's going to be discounting. And up and until this time, everybody who's entered the EV market has enjoyed wait lists. It's clear that consumers want to drive electric cars, but up and until now, most OEMs felt they would never have to entertain a discounting type strategy. And given that Tesla's gone there, what we're seeing with all of the other new entrants from Rivian, Lucid, Fisker, Polestar, even new foreign entrants like VinFast and BYD are all thinking about what is their fleet policy going to look like and what is their discounting strategy. But we're also really confronted with this new sort of reality with the Inflation Reduction Act. The federal government is offering $7,500 of additional tax credit, which as a commercial buyer, we qualify for on every single car. That's not the case for traditional consumers. So
how do you, Scott, how do you pass that on to consumers? Whether they want to, pay, I guess, rent a car for a shorter time or whether they want to lease a car for a longer time. Is it something that you do pass on, or is it something that you just get to keep as the business owner?
Well, we're about flexible term access, so we're not a rental. Rentals typically cost about $100 a day for a Model 3. That's $3,000 a month. Our typical monthly payment is somewhere between $500 and $1,000 a month. So we're much, much cheaper than a rental. We are focused on making sure that out of pocket, we are cheaper than a Tesla Model 3 lease, and we do not come with that commitment. We do pass on all of those savings because the less we pay for a car, the less we have to charge our customers. And so we are not just being faced with the Tesla discount, which turns what was at the end of the year a $49,400 car for us to buy. Today, that same vehicle can be purchased for just under $40,000 from Tesla. You add to that the Inflation Reduction Act tax credit of $7,500, you're all of a sudden looking at the low 30s for a car that was close to $50,000. And we, in states like California, get another $2,000. If the customer qualifies based on their income being below a certain household income of $92,000 in California,
here in New York too.
There's another $9,500. So the sort of takeaway here is that the name of the game is what is our total out-of-pocket capital, because we buy these cars, we run them for between 4 and 8 years. And so if we have less money out of pocket, it's a much more efficient business. We have a much lower cost of capital and we pay less interest expense.
Right.
And we can pass all of that along.
Hey, Scott, just got about a minute left here. I mean, did you have a conversation with Elon, though, after he made his moves? I know you're explaining the dynamics more broadly, but and just got about a minute or so left. Have you talked with Elon about this? Yeah.
I've been a longtime advisor to Tesla. I've known Elon since he first evaluated investing in Tesla and really building this business. And so I've been a longtime proponent of affordability being the key to scaling. And obviously, it's not just what you pay for the car, it's also the monthly payment, because most people who get a Tesla and most people who get any car over $30,000 do not pay cash for that car. They finance that car. Right now, auto lending is almost shut down entirely because with rising interest rates, paying 10% interest on a car loan doesn't make any sense. So subscriptions and leasing are really going to be the name of the game. I believe that Elon does agree with the affordability angle, and really the Tesla discounting strategy has not been driven by companies like us at all. Of course, Tesla made their decision based on wanting to make sure that every trim level of the Tesla Model 3 and Model Y qualified for every available incentive, credit, discount, or rebate available, just to make that car more affordable. And they've done a brilliant job at doing that. So it does represent some headwinds for us, but it also represents a real tailwind because it does result in a discount, and it's created an environment where other OEMs are willing to do the same.
All right.
I think our bottom line is we want to make sure that our cars are affordable and accessible digitally, and our customers aren't going into debt to get them.
We have to run, but so glad we could get some time with you. Scott Painter, founder of FAIR and Autonomy, and our Sean O'Kane. We really appreciate you bringing us this story as well. We've got some bank earnings coming out. We'll get to them in just a moment. Right now, though, a check on world and national news with Dan Schwartzman. Dan.
Thanks, Carolyn Matt. As you've been hearing on Bloomberg Radio, former President Trump has been informed by letter from special counsel Jack Smith that he is a target of the investigation into efforts to overturn the results of the 2020 presidential election. Trump could be facing yet another indictment, as letters of this nature are usually sent to those facing the prospect of indictment. House Majority Leader Steve Scalise says the timing is suspicious.
I'm just pointing out that it's interesting that the same week that you have this whistleblower coming forward to testify before 3 different congressional committees, you see, once again, this isn't the only time it's happened. Over and over again, you see different attacks by the Biden administration against President Trump.
Trump was indicted last month and pled not guilty to 37 criminal counts relating to his handling of classified documents. Trump also pleading not guilty to a 34-count indictment from the Manhattan Attorney General's office for allegedly falsifying business records in connection to a hush money payment made to porn star Stormy Daniels. A U.S. service member who willingly crossed into North Korea at the demilitarized zone has been identified as Private Second Class Travis King. A U.S. official says that King was being escorted from a South Korean prison after being released, and he was on his way to Incheon International Airport when he was able to break away and join a tour group of the DMZ. King, who reportedly said he didn't want to return to the U.S., is said to be in custody right now in the north. According to law enforcement officials, a house in Las Vegas has been searched by police with a search warrant in the murder case of rap icon Tupac Shakur. The artist was shot back in September of 1996 and died from his wounds 6 days later. Shakur sold more than 75 million records worldwide, despite being just 25 when he was killed. Tupac was a 2017 inductee into the Rock and Roll Hall of Fame. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:41 on Wall Street. We do check markets all day long here at Bloomberg, and on a busy day for bank earnings, we are just getting the latest numbers out of Phoenix-based Western Alliance. That's a regional bank that got a lot of attention during the spring banking turmoil. After hours, the stock is trading lower, down now by roughly 5%. It was an up day for the Dow, the S&P, and NASDAQ today as results from Bank of America and Morgan Stanley bolstered bank shares, and a rally in stocks linked to artificial intelligence resumed. As for the overall market backdrop, Mace McCain is Chief Investment Officer at Frost Investment Advisors, and he was a guest right here on Bloomberg Business Week.
At this point, though, with this rally, especially in the growth stocks, we're rebalancing back. We've been through an incredible Fed rate increase cycle, and we don't typically get out of these unscathed. The majority of them end up with recessions.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Ed Morse, global head of commodity research at Citigroup, says oil is unlikely to fall below $70 a barrel, but it would take a, quote, wild card event to push prices above $90 a barrel. Morse made the comment in an interview this morning on Bloomberg Television. Oil stocks mixed today. ExxonMobil down 0.5%. ADRs of BP up 1.3%. Chevron up 0.2%. EOG Resources, among other oil stocks, up 3.5%. Pioneer Natural up by 2%. Again, recapping, stocks higher today with the S&P up 32, up 0.7%. 10-year yield 3.78%. Spot gold up 1.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. A lot of those retail banks coming out, not retail, forgive me, regional banks coming out with their earnings, so something we'll be watching into the Wednesday trade. Something, though, that was on our radar today, Matt, we all talked about it earlier. Retail sales rising by less than forecast, an underlying measure, though, of household spending pointing to a more resilient consumer at the end of the second quarter. But there's always, I feel like, a lot of nuances to these reports.
Yeah, absolutely. And you've got to probably put inflation into the mix as well, depending on which level you're looking at. So it's hard to judge without an expert. Fortunately,
we have one.
We have one with us.
We do. Back with us is Tom McGee. He's president and CEO of ICSC. They represent the spaces where, as they say on their website, where people shop, dine, work, play, and gather. He is with us on Zoom in New York City. Tom, nice to see you again. How are you?
I'm great. It's great to be with you.
Well,
always a pleasure.
Well, we always like having you. You give us some great insight. Tell us about what's going on with folks that are in the retail space, your members, involved very different aspects, right, in terms of your members, but what they are seeing when it comes to the retail group.
Yeah, I think that, today's retail sales indicate, I think what we all kind of are understanding, which is the consumer continues to be resilient. Certainly retail sales today weren't as strong as expected, but if you kind of peel back the numbers, a big part of the decline was gasoline. And if you extract gasoline, you kind of come in much closer to expected levels. Furniture and electronics was strong. Online sales were strong. This is also the summertime, so there's a lot of travel and leisure, so people are going to spend more money in that area as well. So I think the consumer continues to be resilient. Retail continues to be strong, and certainly the demand for physical space, particularly in suburban real estate, is quite strong right now with the work from home phenomenon. So all in all, very strong industry. Occupancy is very strong, but inflation is a risk. There's no doubt about it, and the Fed is purposely, obviously, hoping that the consumer, cools off a little bit as well as the job market. But right now, continued resiliency.
So, how do you see the strength of the consumer right now, Tom? There's this debate at the Federal Reserve level about how much excess savings the consumer has. On the West Coast, they think maybe enough to last through the end of the year. And in Washington, the Fed thinks maybe they don't have any more excess savings. And we do see credit card usage rising. We see delinquencies rising. So what's the consumer look like right now?
Well, you're certainly seeing some signs of softening by the consumer, but you have a strong job market, and historically, when you have a strong job market, and quite frankly, we're at really record employment levels right now, perhaps the strongest job market in modern memory. I would expect, in the absence of some type of major correction in the job market, you'll continue to see consumer spending be strong and the consumer be resilient. How they spend and what they spend, might vary, particularly depending upon what happens with inflation. You might see continued stress on luxury and branding goods and a migration more towards discount, particularly if inflation continues. But we're starting to see moderation of inflation as well. And so with all of that in the mix, my expectation would be continued resiliency by the consumer and continued spending. We're going to, obviously retail sales every month might fluctuate, but overall, I see a strong consumer, and I expect the holiday to be relatively strong as well, which will be.
It's interesting because we highlighted Ralph Lauren, their CEO, talking about they're going to keep raising prices to boost the brand's prestige. So there's that story today, and we had an interview, our Bloomberg News team did. And then you have last week a story by our Leslie Patton about how individuals are trading down on things like toothpaste. And I'm going to tell you, I saw a $19 deodorant that I like, that I usually use. I wouldn't buy it.
$19 for a stick of deodorant.
It was ridiculous.
This is Carol Master's life.
No, it didn't used to cost $19. And I said, I'm not buying it. And I found a $6. No, I found one that's not even a third of the cost. And that's still clean and all that good stuff. So trading down. So I do feel like maybe we're seeing two worlds. And, I guess where are you seeing really the outperformance among retailers? I know you guys think about marketplace, so that can be online, that can be brick and mortar. Where are the bright spots? Where are they not?
Well, certainly discount retail is strong. I mean, that's going to be just based upon price sensitivity. The example you mentioned, Carol, I think you could replace lots of other products and people's experiences with that, whether it's groceries or other type of household items. I think people are, much more price conscious than they were a year ago, and probably rightfully so, given the rise in inflation. So, I do expect you to see continued price sensitivity until inflation really moderates. That said, with a strong job market, and if now we're starting to see inflation moderate, and for the first time this past month, wages exceeding, price increases, that perhaps we're on the cusp of another a pivot again towards migrating more towards higher priced items. We'll see, but in the absence of that, discount. I mean, people are price conscious right now. But interestingly, people are still spending on travel and leisure and so forth, and a lot of that has to do with continued pent up demand, just quite frankly from the pandemic, and a lot of people deferred trips and so forth, during that 2-year time period.
Tom, how's retail real estate holding up? We hear so many horror stories about, or horrible, I guess, forecasts about commercial real estate, and that's mostly about office space. But, here at Bloomberg, we're in a marquee building with a couple of giant empty stores downstairs. What's it look like across the country?
And just got about 30 seconds. Yeah.
Yeah, I think centralized business districts are challenged because of the dependency upon office, which is the example that you just raised, Matt. But I think suburban retail real estate is on fire right now. The demand for space is exceptionally strong, particularly in the open air space, grocery anchored, large discount retail anchored shopping centers. Huge demand for really no net growth in supply over the course of the last 20 years or so.
Interesting. All right. Hey, Tom, take care. Good to check in with you. Tom McGee, he's President and Chief Executive Officer of ICSC, as we said, represent places where we're shopping, we're dining, kind of living, if you will, out in the world, communities, on Zoom from New York City. You're a mall guy, right?
I love the suburbs so much. Is that bad?
No, it's just another interesting aspect of Matthew Miller. This is Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Morgan Stanley shares rallied 6.5% today after earnings. CEO James Gorman spoke about the quarter with Bloomberg Radio. He also reflected on his years at Morgan Stanley.
14 years is it's a long time to do anything, and to run a global bank and deal with all the changes that are going on in the world. It's important for organizations to refresh. So I think it's certainly a very long time to be a bank CEO, and everybody's got to find their own agenda. My focus is on ensuring that this place does well over the next 10 and 20 years. To do that, you need to give the next generation a chance.
And today we did see Morgan Stanley up by 6.5%. You can hear more with James Gorman on the Sound On podcast. You can download it wherever you get your podcasts. PNC Financial Services trims its full-year guidance. That story from Gina Cervetti.
Charlie, it clouds the prospects for other regional lenders struggling to navigate rising interest rates. The Pittsburgh-based lender reduced its forecast for period end and average loans, as well as net interest income, non-interest income, and revenue. The bank cited slightly higher deposit costs, modestly lower loan growth, and softer capital markets in the second quarter as it curbed its outlooks. PNC is a so-called super regional. It's the 7th largest U.S. bank overall, with $556 billion in assets as of March 31st, according to numbers from the Federal Reserve. U.S. Bancorp, the largest bank in that category and the 5th largest overall, is set to report results tomorrow. Charlie?
And this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
Matt Miller here in the Interactive Broker Studio with Carol Masser, debating the benefits of cottage cheese.
I haven't had cottage cheese in a long time.
Apparently, cottage cheese has more protein than beef, more than pork, more than lamb, more than veal, and more than chicken.
It's such an old-fashioned kind of thing, isn't it?
I'm not 100% sure if that's true. This is just from a poster in our Bloomberg Opinion newsletter. In any case, we have a lot more than that coming up for you. Right now, I want to get a check on the world national news picture with Dan Schwartzman. He's here in the Bloomberg 1130 newsroom. Dan?
Thanks, Matt and Carol. As you've been hearing on Bloomberg Radio, a U.S. service member who willingly crossed into North Korea at the demilitarized zone has now been identified as Private Second Class Travis King. A U.S. official says that King was being escorted from a South Korean prison after being released and was on his way to Incheon International Airport when he was able to break away and then joined a tour group at the DMZ. King, who reportedly said he didn't want to return to the U.S., is said to be in custody in the North. Florida Governor Ron DeSantis is in South Carolina. He filed paperwork today that makes him the first major party candidate to appear on the first in the South primary ballot. This comes after the governor fired some staff and trimmed back his schedule to deal with the cash crunch. But DeSantis tells ABC News his campaign is in a good spot.
In the second quarter, we were a candidate for about 5.5 weeks. Our campaign raised $20.1 million. Joe Biden's a sitting president of the United States. To his campaign committee, not the DNC, he raised 19.9. Donald Trump raised 17.7 million, and Trump spent more than we did.
DeSantis is in South Carolina for the third time and does trail former President Donald Trump significantly in most polls. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman. This is Bloomberg.
All right, Dan, thank you so much. Just want to mention Carvana again because that stock is falling in the post-market. Company just came out after the close just a few minutes ago, and it's moving up its earnings report to mañana.
So they're pushing the earnings report or what? Or they're bringing it forward?
Yeah, moving it up.
Bringing it forward?
Yeah.
They're not pushing it back?
Moving it up.
Okay.
Yeah.
Interesting.
Yeah, isn't that interesting? I mean, it's been on a tear, right? I mean, first of all.
Well, it's only up 739% year to date.
But you do wonder, like, what does that mean, right?
Yeah, I do.
Why are they doing
investors are a little bit suspicious, probably deciding rather sell and find out the answer later. Sell first and ask questions later.
Right.
But the stock has just been absolutely on fire. Still, at $40 a share, it's nothing compared to the $400 a share that it hit in November of 2021.
Yeah, and there's been reporting about, their shares have been up, but I guess their bonds, not so, they've been a little bit worrisome. So anyway, I just wanted to mention that. Where else do you want to go?
Is it kind of a meme stock, Carvana?
Isn't it? Wasn't it kind of
It feels meme-ish, right? Because they have trouble making money.
Yeah. Oh, money. Profitability. It's a thing, guys. Can we talk about Ken Griffin buying a Palm Beach property for $83 million?
Yeah, his second one, right? Next door to the old, what was it, a Nordstrom
When the family
or something?
comes to visit, you got to put them somewhere.
It's for an office. It's not for a private property.
Okay.
I mean, he could live there as well. But so the idea is he bought.